Good morning. It is Tuesday, February 7th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Sozzi. Let's take a look at futures as we await Fed Chair Powell's speech. It's slated for around midday. You can see we're seeing a mixed picture. Of course, we've got more earnings to consider as well. We'll dive into all of that. But first, here are the three things you need to know this morning. Investors are on the edge of their seats as they anxiously await Fed Chair Jay Powell's latest commentary. Markets will look for any hints of future rate hikes in the wake of Friday's blowout jobs report.
And Pinterest under pressure. The social media giant issued cautious guidance for the March quarter that has rattled investors and has sent the stock lower.
And Chegg's forecast also disappointing investors. CEO Dan Rosensweig rushing off the threat of AI platforms like ChatGPT. We're going to dive into it today.
All right, let's get started with the first thing to know this morning. Federal Reserve Chair Jay Powell is set to give remarks in the noon hour today. His first speech since the Fed's latest rate hike last week and his first chance to comment on Friday's big jobs number. Yahoo Finance's Jen Schauberger is here to give us the biggest item everyone on our platform needs to know about. Jen.
Hey there, good morning to you, Brian. That's right, all eyes on Fed Chair Jay Powell this afternoon and whether that latest jobs report changes the calculus to raise interest rates higher than previously expected. More than 500,000 jobs were created back in December, a blowout report, though average hourly earnings grew at a pace of 4.4%, slowing down from the pace seen in November. Though that's still well above the 2 to 3% wage growth the Fed would like to see. Now, Powell said at his post-policy press conference last week that the job market is still very strong and that there's, quote, still work to do. He said officials will be looking at the data through March for how much higher to raise rates, but haven't made a decision yet. Though he said rates could, quote, certainly be higher than what we're writing down right now. In December, the Fed penciled in rates peaking between 5 to 5.25%. Now, we will hear from Fed Chair Powell at 12:30 this afternoon when he participates in a Q&A with the Economic Club of Washington. Back to you.
Thanks so much, Jen. Appreciate it. Let's continue to dive into the first thing you need to know today. Investors will be listening closely to Fed Chair Jay Powell's remarks around 12:40 Eastern Time and searching for clues on what the new economic narrative will be after Friday's blockbuster jobs report. To paint the picture, let's bring in Advisors Capital Management Partner and Portfolio Manager Joanne Feeney. Joanne, good to see you as always. Within the past 24 hours, I would argue we have gotten hawkish comments from Raphael Bostic and this morning from Anil Kashkari, really pushing back, I think, on the market narrative that we're getting a Fed pivot. How should investors trade that?
Yeah, good morning, Brian. I think investors need to recognize that the Fed is fully committed to getting inflation under control and that there's a lot more work to be done. You know, clearly inflation has come off of its peak, but the labor market remains tight. Wage growth remains above a level that's consistent with a 2% inflation target. But on the other hand, you know, we do have pretty strong consumer numbers out there, which is sustaining a pretty healthy economy in the midst of all this.
How long do you believe that the consumer numbers that we're continuing to take a look at and parse through can sustain?
Yeah, Brad, it's a bit hard to tell because, you know, we just don't know how things are going to play out over the next year. We're certainly seeing some parts of the economy contract, notably in the tech sector and in those areas which really benefited from the pandemic. On the other hand, when you look at the number of employed people that has risen so substantially, you know, over the last couple of years, what we're seeing is disposable income in aggregate, adjusted for inflation, has actually been rising for the last several months, even though wages aren't keeping up with inflation on sort of a household person-by-person basis. When you aggregate all of the new people that have jobs and those wage increases, you actually see real disposable income going up. And that sustains a pretty strong demand from the consumer. Even as things are slowing, we're still seeing that kind of resilience, which is encouraging.
Encouraging, I guess, unless you're worried about the Fed seeing that and raising rates even more, right? I mean, Raphael Bostic, in an interview with Bloomberg, saying that given the strong jobs report, the Fed is going to need to keep going. Is that sort of a precursor of what we're going to hear from Jay Powell today? And is that going to then discourage the markets?
Yeah, Julie, I think we can count on that. The Fed has been really clear that it sees a need to continue to raise rates and to keep rates high for a sustained period of time until they have convincing evidence from their data, from their work, ground level work, that inflation is going to continue to come down and reach that 2% target. So I think investors might be a little bit premature in seeing an end or a beginning of rate cuts. I think that is not in the cards for this year. And so they are probably going to get sort of a hawkish, as they say, set of comments from Jay Powell today when he speaks. And that might, douse a little bit of this enthusiasm for, the run-up in stocks we've seen so far this year.
And Joanne, since we got those comments, those disinflation comments from Jerome Powell, we've seen some nice trades in the tech sector. How are you trading that sector right now if we do, in fact, get that pushback from Powell later today?
Well, Brian, the thing about the investing in the tech sector is one had really better be long-term focused, right? When you own a tech stock, whether it's a Microsoft, an AMD, an NVIDIA, a Broadcom, you're really not looking at just what's going to happen this year. You better not be. You're looking at what's going to be delivered from these companies in earnings and cash flow over the next several years. And I think the run-up we've seen in the beginning of the year is a reflection of the fact that investors are becoming more willing to accept that the first half of this year is going to be tough. We're seeing declines in earnings year over year, and that's going to continue probably for a couple of quarters. But I think investors are now looking to the back half of this year, and more importantly, even to 2024, where they recognize that these long-term growth drivers, whether it's more 5G, whether it's more data center activity, whether it's more Chat GPT or now Bard coming out of Google, this creates demand for the chips that NVIDIA and AMD provides, for the software and the cybersecurity software that Palo Alto provides. And investors want to make sure they own these companies that are really going to be able to drive growth in their portfolios at a much higher rate than some of the consumer staples. And they want to rotate out of those safer things that they were in last year and make sure they're positioned for long-term growth for the next few years.
We've seen a little bit of a tech bounce to start, or at least a bear market rally for tech to start this year in 2023. Do you believe that valuations are at enough of an appetizing level?
Yeah, Brad, broadly speaking, valuations for the S&P 500 as a whole are not particularly attractive, right? The market's trading at 18 or 19 times. And in a situation where interest rates and inflation are as high as they are, even though they're going to come down, that's not a particularly cheap market. And so you really have to pick and choose and compare where is the stock trading on a PE level, forward-looking PE, relative to what kind of growth they can deliver. You look at a company like a Microsoft trading at like 25 times or an AMD, and if they're able, that's a little bit higher than the market, but they're able to deliver growth that's multiples higher than the market. And so that's how you sort of have to think about whether the valuations are justified.
Advisors Capital Management Partner and Portfolio Manager Joanne Feeney, thank you so much for joining us. Always appreciate your insights and your time.
You bet.
All right, let's get into the second thing that you need to know this morning. Pinterest. The social media company posted its fourth quarter earnings, missing analyst expectations and providing cautious commentary on guidance for the March quarter, saying that it expects sales to increase in the low single digits from a year ago. We've been tracking this one this morning, ticker symbol PINS for everybody tracking it on the Yahoo Finance platform. And one of the things that I saw from the earnings call, particularly that I highlighted within my own notes, some of the CPG advertisers, consumer packaged goods advertisers, they faced headwinds from the macroeconomic environment, the company noting and saying that that was one of those headwinds that the strength that they had seen in other parts of the business was offset by. And so continue to keep a close eye on that going forward from here, but really seeing some success within this, what they're calling this mobile deep linking format here, MDL, on some of their shopping ads. So that's something that we can expect to hear more from about the company.
And the market was initially focused on that advertising weakness, which showed up in, it looks like has continued, according to the Pinterest team, into the current quarter, just in terms of weakness. But pre-market, we're now seeing a pretty large reversal in Pinterest shares. It was down, I think, about 6 to 7% last night, now almost up. And why is it up? For the first time, you're getting a sense that they're cutting big time back in expenses. There's been 2 rounds of layoffs at this company, and they are now teasing really double-digit drops in operating expenses and potential real margin improvement this year, despite weakness in sales. That is a big shift in tone by Pinterest, in large part it comes after a new board member joined the company, in Elliott, after they faced activist pressure. You have that, a new stock buyback, and the sales outlook challenging, but maybe you're starting to get a turn. I do think the street wants to start liking that stock. They just need the sales to start to turn.
This raises an important question, not just about Pinterest, but about so many companies we've talked about this earnings season. At what point is cost cutting going to be enough if the sales are not picking back up, right? And this is true, obviously, not just for Pinterest, but for every big tech company we've heard about this earnings season that's cutting. How long can that last you, sort of not just with your earnings, but in the eyes of investors before that growth has to reaccelerate? How much time have you bought yourself, right? And I think that's a big question. With regard to Pinterest specifically, I saw a lot of analyst commentary around how Pinterest is sort of a second-tier social media platform, if you will. And so when it comes to the ad spending that's out there, if I'm an advertiser, I'm going to choose Facebook first, right? I'm going to choose maybe some of the YouTube first, whatever it is, and then the ad dollars are going to flow down to Pinterest. So in this environment where advertisers are being more choosy, Pinterest is maybe a little bit more on the back foot compared with some of the larger players.
It also becomes a question for the consumer that Pinterest is continuing to tout themselves as attracting Gen Z. We heard them come up multiple times on the call, but when is the spending power and the disposable income of Gen Z going to be enough to buoy Pinterest more so than the spending habits that they may see from some of the elder millennials, if you will, that have come into some of the peak earnings years, and then even on the baby boomers that may be just looking for a good DIY project as well on the weekends, as we all are, let's be real. But at the end of the day, for the number of times that they touted Gen Z and the customer lifetime value that could bring, I think investors here need to evaluate what that timeline to actually cashing in or monetizing fully on that disposable income of Gen Z may look like. And what are some of the other competitors in this landscape that could do shoppable within social extremely well? And that's a broader market share discussion too.
Yeah, we'll just add too, Julia. There is a sense that this company may be gaining a lot of business that Twitter lost because of the negativity on that platform. And I think Pinterest is going to drop in a few weeks some own data, just further, I think, fleshing this out, which should be very interesting in addition to a greater push into social commerce. But I'm going to put all this stuff to Pinterest CEO Bill Reddy, still the new CEO over at Pinterest. I'll be talking to him at 4 p.m. Eastern time. You do not want to miss that chat. Very much looking forward to catching up with Bill.
And the third thing you need to know today, education company Chegg out with its latest earnings. It beat on the top and bottom lines last quarter, but it posted a weak outlook for the year that left investors and analysts disappointed. On the earnings call, Chegg CEO Dan Rosensweig didn't seem to sweat the threat of AI platforms like ChatGPT. And this comes after we talked to him about this at the World Economic Forum in Davos about the outlook for artificial intelligence and the impact on Chegg.
There's a lot of questions around AI that have to be asked, legal questions, ethical questions, who owns this, who owns that. But in the interim, as it relates to Chegg, we will and continue to use it to enhance what we offer. Categories that we're not particularly deep in that we also want to provide inside our service. But I think we'd all agree after using ChatGPT, even as extraordinary as it is, and even as the evolution that's going to come, it still needs human editors.
And he talked about that on the call as well. He was asked a lot about it on the call about ChatGPT, and again sort of said, this is something that we are going to use, not something that is going to threaten us. And indeed, a lot of businesses are beginning to integrate ChatGPT, but clearly the market is concerned about the business overall.
I think at least today the market is concerned, I think, on that outlook. Very back-end weighted. So it really hinges, I think, on Chegg continuing to rebound, getting more new folks on the platform, and then also just driving deeper development amongst the students already in schools. And Brad, we've had just a fundamental shift in how people learn and study because of the pandemic, and Chegg is still, I think, feeling the aftershocks of that major upheaval.
I think for what they said on the call, to your point, Julie, saying that we have been leveraging these technologies within our platform for years, we believe continued advancements will benefit Chegg and students, and been using GPT-2 inside of their writing products there have been, in some instances or another, the elements of artificial intelligence in everything from some of the Microsoft Suite products that you may use on a day in, day out basis, even into the Google Cloud Suite, but we may not necessarily label it as artificial intelligence. We just know that it simplifies some of the processes very quickly, whether that's, hey, can you create a Spark Notes edition of everything that I've just written within this and highlight the main takeaways? That's an artificial intelligence component. More of that is coming mainstream now, and we have now it being baked into everything from our search engines to the cloud servers that we may not necessarily know how they operate, but it's going to be within that framework. All this to say that the language itself of artificial intelligence is changing and becoming smarter. And within that language, I think that's exactly where it could become more personalized in everything from ed tech that we're hearing about from Chegg. It's just a matter of how quickly they're able to innovate on top of what they've already infused within some of their products.
Yeah, exactly.
Well, let's get to today's morning brief. That's written by Julie herself this morning. And the focus here is artificial intelligence and this boom. If you're having trouble just keeping track of all of the recent AI chatbot announcements, you're not alone. The competition seems to have exploded almost overnight. Moves by smaller entrants like SoundHound, BuzzFeed, all the way up to tech giants like Google, Baidu, IBM. As Julie points out, it seems investors are buying now and asking questions later. Julie, I'll toss things on over to you.
Yeah, that's what I wrote about in this morning brief, and it was inspired by conversations that we've been having on set. We've been noticing all of the spikes in stocks that have anything to do with AI, and as I note in the morning brief, it feels a little like 2017 when a lot of different companies were appending blockchain to their name or saying they were doing things with the blockchain. The stocks would go crazy, but obviously that's a lot less popular now, and that really has mimicked many different hype cycles that we have seen. And it's not that blockchain doesn't exist anymore, it's just not as hyped as it was. So that is probably the pattern that we are going to see follow with artificial intelligence. ChatGPT really capturing public imagination with a sort of realistic artificial intelligence bot that one can interact with, and a lot of imagination that has sparked about what changes that can make. So these are some of the stocks that we have seen affected by all of this. And what I'm going to do is switch to a year-to-date look for many of these companies, because a couple of them have caught my eye in particular, chiefly among them BigBear.ai. Now, what does this company do? Something with artificial intelligence. It serves the federal government, it serves the Department of Defense, Air Force contracts, and the like in its various artificial intelligence services. Year to date, this stock is up 800%. It came public through a SPAC, and that happened back in 2021. It's down from then, but obviously has had a big climb this year. So that's just one example, right? You have other companies like C3.ai, which was founded by the software pioneer Thomas Siebel. Those shares have more than doubled for the year to date. It just went public in about 2020. Even something like a BuzzFeed, right? The obviously news and entertainment site said it was going to use an AI bot to make some of its lists, and this is what the stock did. So obviously there's a lot of enthusiasm around this. Whether it's warranted, guys, I think kind of remains to be seen, right?
Well, let's stay on BuzzFeed. I'll even add the Arena Group, too. Of course, they publish Sports Illustrated in my former home, The Street. And for these businesses, you might be wondering, well, why are these stocks getting a pop? What is AI doing for them? And just from the media standpoint, it might be increased content. More content, more places to sell ads. More ads, you bring in more money, better profits, et cetera. Maybe these company stocks go even higher. But even more broadly, outside in the core tech industry, you're thinking more bots, more ChatGPT type things, less human beings, less costs, better profits. I mean, that's very simplistic, but that's why I think you're seeing some of these pops in these stocks.
Well, it makes you think that eventually we're going to see a listicle 8 of the best chat and generative AI tools that are out there.
And as a reader, you have to be careful. Look, from a pure media perspective, you're opening up these articles. Is there a human component, especially when it comes to stock market trading material? I mean, this is going to be, I personally think, a big problem, at least in our business news field.
Well, listen, forget about me. I mean, yes, that is one thing. But you also have to be like, okay, so all of you're saying the thesis that you're talking about, is it worth this, though? Mm-hmm. Is the cost savings and cost, et cetera, are the increased places for ads, is it worth a 218% spike in this particular company? I mean, I think that investors really have to be careful about this. Of course, I want to mention quickly a couple of other areas, though, where we're seeing this, because we got to talk about what's happening in China as well this morning. We are seeing Baidu spike after it came out and talked about its chatbot that it's coming out with. And just if we can look at the extended trade for some of these guys, because Baidu shares are up 12% this morning. It introduced Ernie, as it's known in English, which is its conversational generative AI. And then, of course, we also had Alphabet coming out yesterday and saying it's rolling out Bard, which is its latest offering. So there's just a lot of news on this front. So let's continue the conversation and try and figure out how really big this is going to be and with the changes that generative AI are going to bring for better or for worse. So let's talk to Nina Schick. She is an expert in this area. She's made a lot of predictions about where this is going to be felt in our everyday lives. Nina, it's great to have you here and have your voice on this topic. So just sort of set the scene for us. Why is this phase of artificial intelligence so different from what we have had before?
Well, essentially, this all comes down to a new type of artificial intelligence, so-called generative AI. Last year was really the coronation year for generative AI. And now we are starting to see its real-world applications. It's a type of artificial intelligence that can actually create. It can create anything that we thought thus far was unique to human intelligence or creativity, whether that is interacting with us in a chatbot form, whether that is generating new content, whether it's images, video. It is actually, I think, going to become a foundational new infrastructure for human communication, information, and content generation. So when you start to see all this hype happening, it really is because this technology is going to lead to a tipping point in human evolution, I think. The only analogy I can think of is that it is like the birth of the internet, except it's probably even more profound.
Okay, and so that kind of brings me to my question here, because I was actually looking at one of the polls that you posed to the Twitter audience and talking specifically about two big players because of the investments that they've made. One of them being, of course, Microsoft and ChatGPT there, and then the other in Google. And of course, that was focusing more in on search, but is any of the generative AI investments that we've seen thus far, is it necessarily a zero-sum game?
Absolutely not, because there is so much abundance to go around. But when I made my predictions for key trends this year, one of the predictions I made, which is already coming true, is that all the big tech titans are going to want a piece of the action. And how they've been doing that so far is by collaborating with some of these generative AI startups or smaller companies. Now probably not that small anymore, the kind of OpenAIs, the DeepMinds, the Anthropics of this space. And when OpenAI released ChatGPT, it's been 2 months, by the way. It's been 2 months, and it's the most popular application in the history of the world with over 100 million users. It was very clear that Microsoft understood that this technology, which, by the way, is only one application of one type of generative model, a large language model, that this was going to be something that hundreds of millions of people would interface with this year. No wonder that the Googles and the Baidus are realizing, oh my goodness, if we don't ship a product in this space soon, this is going to be monopolized by Microsoft, which is why you see this mad rush. I mean, Microsoft announced its extra $10 billion investment in OpenAI a few weeks ago. Now they've already integrated ChatGPT into Office, into Teams. It's going to be integrated into Bing. You see Google yesterday announcing that they're going to do the same. You see Baidu saying they're going to do the same. So it is a real race, like I said, amongst the tech titans. And remember, the bigger picture is that this is only one application of one type of generative AI model.
So, Nina, to go back a little bit to what we've been seeing in the markets and everything that had a whisper of AI has gone crazy this year. You likened it to the beginning of the internet. Of course, a lot of companies that were around in the beginning of the internet are no longer around. We had the dot-com crash. Is this enthusiasm then, on the flip side, going to be accompanied by a crash where a lot of these players maybe are going to shake out?
Absolutely. I think there is no doubt. I mean, when ChatGPT was released, given that it was such an immense cultural moment, a few weeks ago, there were all kinds of memes circulating about how investors were suddenly backing out of their crypto and metaverse investments and just rushing towards anything with the words AI or generative AI in it. And that hype cycle was another one of my predictions for this year, that this hype cycle, this investment is going to turn into an investment hysteria. And there are no doubt going to be lots of companies that fail, lots of people that lose their money. But ultimately, just like the internet, is generative AI long-term going to be a game changer? Without a doubt. And are there going to be companies built in the space which are going to be the next trillion-dollar companies of the world? Again, I think so, without a doubt. However, right now, sorting the wheat from the chaff is going to be the order of the day when it comes to investing.
So in terms of way forward from here, we have to focus in on the ethics of generative AI as well, and where that really enters into the frame for businesses as well as for individual use.
Absolutely. Again, this is such a profound moment for society because these systems are fundamentally going to change the nature of the information ecosystem. They're fundamentally going to change the content and information we interact with on a daily basis. So as the hysteria grows and increasingly companies enter this space who are desperate to kind of bring their products to market, one of the side effects is that you're going to see a loosening, shall we say, of kind of ethical guardrails or safe deployment of their technology. And you've already seen stories of like how certain companies in the space, voice cloning companies, quick to want to ship their product, didn't kind of put any safety rails in place, and their technology is now being misused by 4chan users to make Emma Watson, the famous actor, read Mein Kampf in an AI-generated voice. So you're going to see lots more of that. And broadly speaking, however, the philosophical and societal implications of how generative AI is going to shape our society are going to be the major questions we're going to be debating in the next 5 to 10 years. Questions like, is AI going to augment or automate us? How is AI going to change the world of work? Who should control these almighty systems? And is it okay if private companies or a few well-resourced actors accrue so much wealth, influence, and power, much more than that of a kind of elected nation state? These are the questions I think that are going to be playing out on a broader societal level, like I said, in the next 5 to 10 years.
And Nina, just quickly here, you're also an expert on this kind of stuff, deep fakes and the like. Do we have any power as individuals, as consumers, to even know what's real and what's not in this new world?
So you touch upon one of the most important existential points, and that is that as the information ecosystem becomes inundated with AI-generated content, and basically anything we interact with can be generated by AI, it can be synthetically created. The question of can we even trust anything anymore, even if things like video, which we tended to see as an extension of our own perception because they're so difficult to manipulate, that is going to become an existential question. So we have to look at technologies that are going to help us navigate this kind of inundation of the information ecosystem with synthetic media. And we have to look at things like authentication, transparency in all content, whether it's synthetically generated or not. Otherwise, I mean, if there is no trust in the entire digital ecosystem, then that's an existential risk, not only from a political perspective, but from the perspective of every business and every individual as well.
Nina Schick, author, advisor, speaker, specializing in all things generative AI. Good to see you this morning. Thanks for the perspective. Appreciate it. Lots of action around Bed Bath & Beyond to keep an eye on. The company's ticker page is the most visited on Yahoo Finance today. After rocketing yesterday, it's a very different story for the shares this morning. As you can see on the screen, they're crashing in pre-market trading after the company announced plans to raise cash through an offering of preferred stock, another move in its ongoing bid to avoid bankruptcy. According to the regulatory filing, Bed Bath is aiming to raise more than $1 billion, but Wedbush still slashed its price target on the stock to $0 from $1, suggesting the capital raising effort was a last-ditch effort to avoid bankruptcy. We'll have more analysis on Bed Bath's Hail Mary pass later on in the show. And, well, we're coming up against that opening bell here on Wall Street, watching, of course, Bed Bath & Beyond, and it's a bid to stay alive. We have earnings season continuing to roll right along. Pinterest maybe reversing a little bit in the pre-market. Chegg under pressure here. But, again, all eyes on this Federal Reserve conversation with David Rubenstein later on.
Yeah, the Fed conversation with Jay Powell is going to be the market-moving event of the day, of course. And ahead of it, we have a couple of conflicting commentary or different commentary color coming from other Fed members, including the Atlanta Fed President Raphael Bostic, who spoke in an interview with Bloomberg. He's not a voting member of the Fed, but Ben Amons, among other commentators, has talked about that Bostic lately has kind of presaged what the voting members of the Fed are going to do. And he has said, especially given the jobs report on Friday, the Fed's probably going to have to keep going. He hasn't changed his view. And this whole debate over whether the market is mispricing what the Fed is going to do, that debate is only going to get more acute.
Yeah, that means that we could have a outsized kind of volatility week for some of the most pressured stocks on any of the commentary from the Fed that we had seen last year as well. And what are those sectors? Consumer discretionary, that could continue to be rattled a little bit with any of the commentary that comes forward over the course of this year, but also keep an eye on XLK. We were having this conversation earlier just around some of the valuations even at this level. So keep a close eye on tech and consumer discretionary.
Now, McCormick, the Spice King's ringing that opening bell.
They've got great spices. You know I love my spices. I'm still upset you didn't give me some spices when you were in Seattle last year.
I can't do everything here, guys.
Pike Place Market spices, the fish stuff. It's
yeah,
great.
I actually used to live not too far from a McCormick plant, and you could definitely get the wafts of spices.
That's kind of cool.
It was kind of cool, indeed. So those folks ringing the opening bell this morning on this mixed session that we have seen thus far. So Brad, what are we seeing as we get underway this morning?
Yeah, chili flake spice start to the morning here. We're seeing some red on the day. Out of the gate, the Dow is down by about 0.5%. You're also seeing the Nasdaq Composite. Let me populate this chart for you here. Past 2 days down in aggregate by about 1%. Flat just barely to the upside right now, though. We'll see if we hold on to some of those early morning gains for the tech-heavy average. S&P 500, you're seeing that to the downside by about 0.25% right now. Over the past 2 days, down 0.9%. We're going to take a look at some of those sectors here early in the morning, early in today's trading activity, just after the opening cross. 11 S&P 500 sectors here, and yeah, let's put this on a intraday view for you there. And we've got more laggards than leaders. As of right now, though, energy, you're seeing that up by about 0.6%. But take a look at this. Interesting. Technology, that's up by about 0.2% here on the day, coming into, of course, what's going to be a big Fed speak week, or at least period, for the next few days here. And then additionally, some of the biggest laggards that we're seeing right now, XLRE, that's down by about 1.4%. We'll ride out with a quick look at the Nasdaq 100 here. For some of those mega cap tech stocks, you're seeing them a little mixed. Apple, early morning waffling there on the day. Investors deciding whether or not they want to take a bite of the apple. But Microsoft, that's up by about 1.4% as of right now. We will be right back after this short break.
Let's check in on some Yahoo Finance trending tickers here, starting with CVS, as the company is reportedly closing in on a deal to acquire primary care center operator Oak Street Health for over $10 billion. And CVS is just, looks like it just wants to gobble up so many of these locations. At what point do regulators step in here and say, hey, why CVS is going to have all of our health data, essentially?
Well, I mean, because it's sort of horizontal integration, I guess. In other words, it's getting into different Let me back up. The primary care business is still very, very fragmented across the United States. So maybe at some point, yes, regulators are going to step in. But CVS is not the only one. Amazon is trying to do this as well with One Medical, although the FTC is reportedly looking at that deal. So maybe, yes, we will see regulators step in. But I've just been fascinated by this trend recently of other kinds of integrated healthcare companies getting into the doctor business. It's a sort of a strange turn of events.
I think what's remarkable about this for CVS is that not only would you have the ability for management of some of the different kind of healthcare insurance plans. We know, of course, the CVS Aetna deal that had taken place back in 2017, 2018, and how that set them up to fuse together the pharmacy side of the business with the insurance side of the business. And then you go forward even further from here. It's all of these primary care centers, to your point, Julie, that have been getting even more of the looks. Amazon's acquisition of PillPack was no coincidence, I should say, because that set them up similar to combining a pharmacy then later on with another type of primary care play with the One Medical acquisition there that's getting some holes poked in it as well. But I think at the end of the day, this $39 per share equity and debt type of deal that we're seeing for CVS just further some of the attentions, not just to manage the data, but hopefully to add further of a vertical integration and a seamless experience for end consumers around this, because the healthcare system is so siloed in many different respects. And if we're able to see some entities start to bring that together and make sure that it's not harming some of the competitive landscape as well in the process, I would say that that's good for consumers as long as pricing does not skyrocket higher.
Well, hopefully the opposite will happen.
Right.
I mean, Amazon is known for value, right? Mm-hmm. Known for trying to keep prices down, sometimes at the expense of margins. So will this be something, and my guess is this is what the acquirers will argue, that can actually bring down costs for consumers and for insurers? Whether that's the case, I think remains to be seen. I mean, listen, if I'm CVS and I own Aetna, and I'm also providing care, don't I want costs to be low for Aetna? The problem is also if you are sacrificing quality of care, if you are trying to save costs by saying no to covering certain things. I mean, so it's all, I don't know. I feel like I need to talk to Megan Fitzgerald about all of this, who's a frequent guest on the show.
Well, speaking of silos,
she knows a lot about
yeah,
this.
absolutely. I mean, well, just speaking of silos, I walk into a CVS store at these thousands of stores, and now they're also in Target. There's no clear indication they even own Aetna. So if they go out and buy this asset, when do they really start integrating it into the store experience? I would argue they have not done a good job of that. And of course, reach out to CVS for comment on this deal. They did not return our request for comment.
Yeah, I think that was part of the strategy, excuse me, at the outset of that acquisition. They had said kind of early on, I think a few years back, that they were still going to let Aetna be a standalone. But again, I think it is smart for them, to your point, to start to fuse together the two brands a little bit more, at least let the common consumer know that there is this conjunction, and an effort to hopefully add more of the ability for them to engage and kind of decide what pricing strategy works best for the household level too.
Yeah, someday I guess you'll be able to walk into a CVS, and if you buy a chocolate bar, you'll get an alert on your phone saying, you're on Aetna, you may want to put that chocolate bar down, folks.
Not
good for your cholesterol.
If they know
one for the
everything.
grave. Put that bar down.
All right, let's talk about another mover. Keeping an eye on industrial materials maker DuPont. The company beat estimates on the top and bottom line. It did come up short on its guidance for the first quarter, and the shares are actually up by 5%, which is perhaps a little surprising because that first quarter guidance was pretty lousy. They're talking about earnings per share of 80 cents. That's 9 cents below what analysts were estimating. But indeed, the last quarter they matched on revenue and beat on earnings per share. The company is talking about for the full year that they are expecting continued strength in particular areas of the business, water and auto adhesives, among other things, and stable demand across industrial end markets. So perhaps that's encouraging to investors. The company, by the way, is also raising its dividend by 9%. So maybe that's bringing in some folks.
And the only reason I really care about DuPont, yes, DuPont, old company, I get it, but really I use their earnings for clues on many other companies. And if you go into their earnings release, and it's a good read, really helpful. If you're up this morning, you're trading check out this DuPont release. And you go down the page and you go to the semiconductor technology section, and they talk about weakness in fab utilization rates. That immediately has me a little concerned on what Intel's trying to do, try to develop its own fabs, and seeing weakness there as it tries to roll into that. Industrial, to your point, Julie, weakness in auto. We heard that from Ford when they reported last week. Weakness in semiconductors. We've been hearing that from a lot of players. And then this was also interesting, calling out weakness in smartphones and personal computing. And this, of course, of course, the whole week started this week with Dell firing 6,000 people. So really cool earnings release to pick through.
Yeah, Ed Breen, the executive chairman and CEO of DuPont, saying within this report, the face of weak conditions, certain end markets, namely here electronics and construction. We've continued to hear that. They still delivered some revenue and operating results in line with their expectations, but it still is so much about that forecast going forward from here and where some of the offsets, at least in their improvement against their own benchmarks, where that starts to materially, or at least hopefully, move in their favor. But as of right now, some of the fabrication process that you mentioned, it's tough to bring any type of nanometer technology production online and in a rapid clip to the point that investors would be appeased.
Not a fab situation yet there, Brad.
Yes. Fab Fit Fun. All right. Also, watching shares of ZoomInfo, ticker symbol ZI, after the software and data company topped estimates for the fourth quarter, exceeding expectations on the top and bottom lines. However, they did issue here weaker than expected guidance for the full year. You were taking a look at some of the actuals versus the estimates on your screen there. And one thing that did kind of jump out to me within this ZoomInfo report, as I just thumbed through my notes here, it was the fact that they were talking about here demonstrating this value proposition, driving a go-to-market motion for customers, quick time to value, tangible long-term ROI. All that to say, this is still a business that has about 4,300 ZoomInfo users across sales, marketing, operations, and talent roles. But it's really just about how they're going to grow out the business from here and make it so that investors get a sense of what the actual growth trajectory looks like. Because to me, if I read this report, and we read a lot of earnings reports, but I look through this and I'm just like, okay, this just seems like a lot of jargon. And anytime there's overly a lot of jargon in earnings reports, it kind of gives you the sense that, all right, what else is underneath of the water on a company like this?
It is, of course, is led by Henry Schuck, who's a frequent member or person that comes on and talks about his business. But, you know, the sales up last year, 47%. The company's still outlining sales growth for this year, still outlining operating margin improvements year over year. It's just another, I think, just caught in this tech cycle wave where it's just whatever you do is just not going to please the street.
Well, the first quarter outlook was bad. Yeah. That's why the stock is down, right? It wasn't that bad considering how much the shares are down. But when your revenue at most is going to be $301 million and the street is looking for almost $305 million, it's not great in this environment. UBS, by the way, also downgraded the stock to neutral, saying that the shares could be range bound in the meantime. So none of that helping matters.
Yeah. Well, we'll continue to track shares of all of these companies moving forward throughout the rest of today as well. Coming up, Yahoo Finance's Jared Blickery going to break down the latest market action at the open on the other side of this short break. Plot. Welcome back to Yahoo Finance Live, everyone. This morning, we're seeing some mixed activity among the U.S. major averages here as we're 15 minutes into the start of trade on the day. Let's get on over to Yahoo Finance's Jared Blickery, who's over at the Wi-Fi Interactive. Hey.
Hey there. Yes, a mixed day, but the Nasdaq is leading. That's the takeaway that I'm getting. And that's important because that has been the case for the year. Before we go into our heat maps, I just want to spend a little time on the U.S. dollar index. This is a line chart. I want to put some candlesticks. The low we saw was basically in 2021. So early, let's say late in the year of 2020, that was the year of the pandemic, and early 2021, we got this double bottom here, came all the way up. This was a huge pain trade, this move in the dollar, and that was fueled by the rise, the expectations that the Federal Reserve is going to raise interest rates, which they have been. This has been incredibly strong. Now, the retracement here has been 50%, half of this whole move. So this is the ideal entry point for traders. And the fact that we got these 3 green bars now, that tells me that they're trying to get long here. It doesn't mean that they're going to succeed. We could still go down and puncture these lows here, but the trend, a very, very small uptrend, is in place here. And when you take it in context of the longer trend, which is still up here, we got to pay attention to that. That would provide some pain for equities. And you take a look at what the 10-year T-note has done as well. Let me dial this down to a 6-month chart. This is creeping higher. And then let's go to the very short end of the curve, the 13-week T-bill yield. Hard to see here, doesn't move a lot, but we are right up against these highs here. And this is factoring what the Federal Reserve is going to do with its benchmark. And I think all the more relevant today because we have Chair Powell in front of Congress. So definitely expect some noise on that front. Now, today we got tech in the forefront, followed by materials, energy. Those are the only sectors in the green. Staples, real estate, utilities, those are the ones taking it on the chin here. That is good for the market, I guess, of risk on, because those are the defensive sectors. We're just not really seeing much getting bought just yet. K-Web, Chinese ETF, that's getting some love here. Chip stocks, transport, software, a little bit of love. Meme stocks perked up yesterday. I just want to spend a little time there, see what they're doing, because we talked about the Best Buy or the Bed Bath & Beyond news, and I can't even find them on here because the stock is so small, but they are down 44%. So really giving back some of those big gains they saw yesterday. Used to be that when you're raising capital nowadays, for a meme stock, that's a good thing. Usually the stock goes up. I say that tongue-in-cheek because that's not supposed to happen, but with meme stocks, you never know.
Don't worry, Jared. Consumers can't find those stores either.
Okay.
They're just really disappearing. Jared Blickery, thanks so much. Corporations use the power of the stock buyback in the fourth quarter to pad profits and bet their stock price wouldn't stay down for long. Of the S&P 500 companies that have reported 4Q earnings, they spent on average 9.6% more on stock buybacks compared to the third quarter, according to data from S&P Dow Jones analyst Howard Silverblatt. Silverblatt estimates that this year will be the first year with over $1 trillion spent on buybacks. That's a big, big number. Coming up, we're powering up some gaming company earnings analysis from Activision Blizzard and Take-Two Interactive. That's next.
Gaming companies are in the spotlight this week because of earnings. Activision Blizzard's one of them. It's getting a boost after reporting a 43% pop in net bookings in the fourth quarter year over year. Saw monthly active users increase to 389 million. Raymond James Internet and digital media analyst Andrew Marek joins us now to break down the quarter. Andrew, I have to say a lot of my thoughts and questions about Activision don't have to do with the quarter and how it's doing now, but rather what's going to happen with Microsoft, what's happening culturally inside the company. But before we get to that, give us your sort of high-level takeaways about the quarter.
Sure, and thank you for having me on today. The quarter for Activision Blizzard was quite strong, we think. And notably, not only was it Call of Duty, which we know had a blockbuster launch, being the fastest release in the franchise's history to garner $1 billion in sales, it was actually across the portfolio. The Blizzard segment, which is home to World of Warcraft, Overwatch, Diablo, World of Warcraft and Overwatch also had releases in 4Q. That was above our expectations as well. And even King, the mobile segment, which is dominated by the Candy Crush franchise, posted some pretty strong bookings growth as well. So the depth of the outperformance in the quarter, we think, was the most encouraging part.
Okay, and so what have you seen, and as we're showing some of the net bookings for Activision Blizzard, bookings have been the larger question mark for a lot of the gaming companies, quite frankly, in the face of some of the weakness in the spend that the gamers are willing to come back in those in-game experiences and continue to pony up. Have we been able to see any of the strength start to reemerge, or is this an instance where it's going to be kind of title by title and thus company by company basis instead of a kind of broader tide type of situation?
Yeah, I think it's the latter. And that kind of goes into our thesis that we're moving away from some of the more exogenous factors that have impacted the gaming space over the last couple of quarters and even years with the moderation of pandemic engagement spikes, and now getting into the relative performance of the games, of the pipelines being the most important determinants of the company's and stock's performance. What we're seeing kind of right now is a divergence in the big franchises, which are getting bigger. Obviously, Activision with Call of Duty and Overwatch doing very well this quarter. EA citing FIFA as a particular point of strength boosted by the World Cup. And they're kind of diverging from the more lower and mid-scale releases, which even large-scale publishers like EA and Take-Two called out as kind of tough in the December quarter to compete against those bigger-scale releases where we think attention and spend is flowing to.
Does that divergence make it more difficult for an Activision, Blizzard, Microsoft to prove that there wouldn't be any disruption in the consumer environment, especially as they're trying to get this deal all the way done?
I think in general, this is not a structural change that we're seeing. I think it's probably a bit more transient, given that, you know, if players are maybe a little bit more budget conscious at this point, choosing to engage with one experience over a number. But in general, the gaming industry has shown to be very robust in terms of at least the number of competitions. It's a fairly low barrier to entry, high barrier to scale type of business where a lot of independent games come to market every year. Many of them see a good amount of success. But in the end, it is a scale industry. The barriers to things like marketing and AAA development costs and things like that do benefit the larger players.
James, is AI a friend or foe to video games?
In general, we would think that AI is likely a friend to gaming in that it can help either automate some of the development processes that are underway now in game development, or create new opportunities for things like dynamically generated games and things like that, which would not have been possible even a couple of years ago. I think how we would analyze the AI through the lens of gaming is how does it interact with the player experience? Does it make the player experience better? And if it can create new and innovative ways of players engaging with games, it's definitely a friend to the industry.
So, Andrew, sorry, to go back to Activision for just a sec. Is Microsoft going to get the go-ahead or not? What do you think?
Well, that's the $69 billion question right now. The UK's Competition Markets Authority is likely to issue their provisional findings in the review of the deal any day now, we think at this point. And that will be very indicative as to where the deal is likely to progress. We've spoken to some experts who are a little bit more cautious on those prospects. We've seen some reports that suggest that the UK is a little bit more optimistic on the deal. So in short, it's kind of it'll kind of be a bolt from the blue, I think, when we get those provisional findings, because they do tend to be very indicative of what the final decision is meant to be. And we do believe that as the UK goes, the other large geographies like the EU and the US are likely to follow.
We will be watching for that closely then, Andrew. Thanks so much. Andrew Merrick of Raymond James. Appreciate it.
Thanks for having me.
Coming up, today's focus maybe on Jay Powell, but it's still results season. We're going to bring you what you need to know next. Of course, big picture today, people are focused on Fed Chair Jay Powell and his comments later, but we have a lot of earnings to consider. Here's a heat map of some of those earnings. Want to zoom in on some of them further. We've got Hertz Global Holdings. Here's the 2-day chart, but if you look at the 1 day here, the stock is up better than 7.5%. The company's earnings beat estimates. This is even after we have seen pricing come down for used cars in the second half of the year. And Hertz, in addition to renting cars, makes a lot of money from selling those cars once their life is used up in the rental cycle. And so the fact those prices came down hurts to some degree, but still beat estimates. Also, if we're talking travel, let's talk about Spirit Airlines. Those shares, not much change. They're up just about 0.75%. A little bit of good, a little bit of bad here for Spirit. On the one hand, the company came out with earnings per share of 12 cents. That is better than had been anticipated for the company. Operating margin also better than estimated at 4.1%, but the company says in the first quarter, adjusted operating margin will be -2% to -4%. Full year capacity is going to rise 19 to 22%. Capacity is something that airline investors watch closely. And then KKR shares up better than 1.5%. The company has now more than $500 billion in assets. Didn't sell too many assets, though, and so that means that its earnings fell by 41%, but it looks like those assets under management getting a boost is good news for KKR. Those shares, by the way, up about almost 23% for the year to date. So a little survey of some of the other earnings that we are watching right now. Coming up, what the Live Nation backlash means for corporate monopolies, whether anything's going to change. We'll talk about it next.
Welcome back to Yahoo Finance. I'm Brian Sozzi alongside Julie Hyman and Brad Smith. Markets are on edge ahead of an interview between Fed Chief Jerome Powell and Carlyle co-founder David Rubenstein in the 12 p.m. hour. Right now, we're seeing all three major indices in the red, Dow down close to 100 points. Here's what's on tap this hour. The monopoly of concert ticketing. We'll get some fresh perspective from one key expert. Hailing a pre-earnings call on Uber. We'll have one analyst set up on the name ahead of earnings. And is it game over for Bed Bath & Beyond? New wrinkles to this ongoing saga emerge. Brad, over to you.
All right, thanks so much, Brian. Well, switching gears here, taking a look at some of the major averages just very briefly as we begin the top of this 10 a.m. hour on this Tuesday. Dow Jones Industrial Average, you're seeing that lower by about 0.3% right now. The Nasdaq Composite, that's also in the red by about 0.2%. S&P 500, that's down by about 0.25%. Some of the declines are really adding up right now in consumer discretionary. Let's take a look at some of the sector performance. As you're seeing here, more laggards than leaders right now. Energy leading the pack. That's up by a little more than 1%. However, bringing up that caboose, we've got XLY, consumer discretionary. That's down by about 1.5% here. Also wanted to just briefly take a look at where some of those declines in spending at least might be racking up, at least on the stock performance front here on the day. And apparel is getting hit hard. Nike is down by about 1.6% here early in trade on the day. You've also got Lululemon in concert also moving lower. In fact, there's not a bright spot to be found unless you look in this far right bottom corner here. I'll put this on an equal so you can see exactly who that gainer is, and it is VNCE, Vince Holding. Interesting. That's up by about 1.4%, but perhaps that dovetails into the story about some of the more affluent consumers, I suppose, being able to or wanting to spend on some of that apparel. But anyway, as you're seeing, a very red scenario right now for some of the apparel names. And in terms of how people might be spending their money elsewhere, the concert ticket catastrophe, ticket booking giants Live Nation under intense scrutiny over how it handles prices and allocates tickets, with critics calling for a breakup of the company. These most recent calls follow a recent congressional hearing over Live Nation's mishandling of Taylor Swift ticket sales. Joining us now, Krista Brown, Senior Policy Analyst at the American Economic Liberties Project. Krista, great to have you here with us today, especially off of the back of another big tour sale. A lot of people, a lot of Queen Bee fans out there, they've been looking to get tickets. And so all of this adds up, as we had already seen the debacle that took place with the Taylor Swift tickets. So help us lay out the scene here, especially as it relates to Ticketmaster and Live Nation, and how these entities have all come together over the years.
Yeah, thank you for having me. So essentially, these two companies have been acting pretty monopolistically for decades at this point. Prior to the 2010 merger, Live Nation had consolidated the concert promotion business throughout the 90s, started by this man, Bob Sillerman, and that company initially was named SFX. It got rolled up into Clear Channel, a radio consolidator, and then spun off to Live Nation. Ticketmaster did the same, starting even earlier, rolling up the ticketing industry in the 80s and 90s. And the two, they were acting with exclusive arrangements throughout the 90s. So prior to the merger, they already had this vast control of the industry. Both actually had been probed for antitrust issues by the Department of Justice. And then in 2010, their informal marriage was formalized and they merged. And that's kind of what we see today, where we have this vast consolidation and we get one ticketing platform, essentially the largest promoter that also has exclusive arrangements with the majority of large venues. And that's why people like Taylor Swift, despite not using them as a service for her promotion of the Eras Tour, had to go into their venues and use their services.
Krista, I feel like people are letting the artists off the hook in this whole situation. They're making money from these arrangements. And yes, you had Pearl Jam protest this at one time, but they were really the only one. Radiohead to some degree also. I mean, aren't the artists complicit in this whole system as well?
I would not say that they're at least close to the same level of complicity here. Back in 2009, Bruce Springsteen came out saying that the merger of Live Nation and Ticketmaster would essentially spell an end to fair competition in the industry. It would be the worst thing, I believe, is his exact words for the industry.
Yes, he said that, but he's still playing all of the Live Nation venues. And, while he might say words about the high ticket prices, he has a price that he wants to get paid, right? He has cost that he wants to get paid. And I feel like the artists are not looking too carefully into how Live Nation Ticketmaster is paying them that money. They're not breaking it down, right? They just say, here's the amount I want to collect. You guys get it the way you need to get it.
Yeah, I think, Pearl Jam actually did have that approach in a lot of ways. But the band that just testified, Lawrence the Band, did an incredible job actually explaining the breakdown of costs. And they recently were on CBS with a segment showing a term sheet where they were charged for facility fees that were covered supposedly by fees that fans were also paying on the ticketing service. So although absolutely they're trying to make money, they deserve to make the bulk sum of what's made up through revenue sales on ticketing, they also have no other really room to negotiate with another large promoter like Live Nation. And again, this is because of the control they have over venues, the vast control over the ticketing market, both in primary and now a growing presence in secondary. So I think it's a little bit misconstrued to think that, the artists are also buying into this whole monopolistic scene. I think historically there has been a much healthier environment for them to pursue different ways of becoming an artist and a living wage artist. But Live Nation has really destroyed that at every turn. And they did so in the early 2000s by eliminating album sales with this kind of scheme called Instant Live, which, you can read more about. I won't go into too many of the details, but they've kind of stripped the ways that artists make money besides live touring. And they have said that in various lawsuits that live tours make up 95% of the artist's revenue. I don't think any artist wants to have that be the bulk of their revenue, because obviously it's a tiring process, very hard to have a normal life when you're on tour all the time. But that's what's come of it, and that's partially because that's what makes the most money for Live Nation Ticketmaster.
If it did happen, how would a breakup of Live Nation impact consumers? And where else would they be able to go in order to get tickets for concerts for some of their favorite artists that might fall under entertainment companies that are even owned by Live Nation Entertainment?
Yeah, so in my mind, a breakup would be the simple separation of Live Nation and Ticketmaster, the concert promotion business and the ticketing service, but also then probably forcing them to not enter into exclusive arrangements with venues for, say, like 10 years or something, just so that other competition can actually enter the market. Because without these guardrails, it's going to be hard to incentivize investment for smaller companies to actually build up a market presence and have fair competition. Again, like you can look at what happened in the 90s. They were not a merged company, but they did have exclusive arrangements that gave them kind of total control. And for fans, I think it might not mean that different of an experience in the ticketing sphere. Potentially Ticketmaster will still have the largest or best service, but there will be a way for other ticketing services to actually vie for being a ticketing aspect of a various venue or a various tour. And that will give artists like the frustrated Taylor Swift fans the choice to pick between Ticketmaster or an alternate platform. And we see this in Europe, where they actually they don't have exclusivity. So you can use various ticketing services for the same concert, the primary service for the same concert, and it has kept fees down. It's also led to a more competitive sphere, and that's what would likely happen with a breakup.
No one wants frustrated Swifties, to be sure. Krista Brown, American Economic Liberties Project Senior Policy Analyst. Appreciate the perspective this morning. Thank you.
Thank you.
All right, ahead of Uber's earnings on February 8th, longtime tech analyst Mark Mahaney at Evercore ISI is making a bullish call on the ride-hailing giant. Says Mahaney, based on intra-quarter data points and our own analysis, we believe Uber will likely print an inline Q4. In our view, we see the street's Q4 and Q1 bookings, revenue, and operating profit estimates as ballpark reasonable. Uber remains one of Mahaney's top picks, mostly due to the company's market share lead over rival Lyft. Coming up, SoftBank's losses are escalating amid the tech fallout. Julie will discuss that, plus have more top headlines you need to know next.
Let's get you updated on some other headlines we're watching. Record annual profits for UK energy giant BP. The bottom line more than doubling to almost $28 billion last year. Of course, benefiting from prices soaring after Russia's invasion of Ukraine. Shares are jumping this morning on this, as well as a dividend hike and a boost to share buybacks. Energy investors love that. But bad news for climate activists. BP announcing it's paring back plans to reduce oil and gas production by 2030. The oil major, just one of the European energy companies benefiting from the jump in oil prices last year. Rival Shell also seeing record earnings of almost $40 billion. Apollo Global Management is reportedly one of a group of financial firms sizing up a stake in Credit Suisse's rebooted investment bank, this according to Bloomberg News. Credit Suisse last year announced plans to spin off the advisory arm of its investment bank into a new unit under the CS First Boston brand. Remember that? This entity had been identified as a home for CS's capital markets and advisory activities during a strategic overhaul that was announced in November. The Swiss bank has for years made efforts to boost units outside its prestigious wealth management arm. It's also faced scrutiny from a series of high-profile scandals. Apollo Global Management, by the way, is the parent company of Yahoo Finance. And the higher rate environment causing problems for tech stocks and their biggest investors. SoftBank's flagship investment arm has reported its fourth straight quarterly loss as the Japanese group battles slumping valuations across the sector. The business's Vision Fund posted a pre-tax loss of 660 billion yen in the December quarter. It's been a busy couple of years for SoftBank. In 2022, it sold shares in Alibaba and all of its remaining stake in ride-hailing giant Uber in a bid to raise cash. Saz?
OpenAI's ChatGPT is already making its way into different areas of the job market. Yahoo Finance tech reporter Ali Garfinkel joins us now to break down how and where it's being used by businesses. Ali.
Hi, Brian. So a lot of the reasons and ways we've seen ChatGPT go viral have been creative or off-kilter in some way. Things like write a love sonnet to my rice cooker or tweets that could have been written by Elon Musk. But I think it's also really worth looking at the ways ChatGPT is being used today already in businesses. I want to pull out three. We found more. We found five and more. But I think there are a couple that are, I think, really worthwhile. The first is healthcare, right? Now, this is a scary thought originally, but the applications of this we're primarily seeing right now are predictable and preventable sicknesses. We're talking colds, flus, eczema, things that your mom has the answers to. Importantly, AI chatbots are already being used in healthcare, so we can think of ChatGPT for now in healthcare as sort of an enhancement to those. The next one, real estate. This is one we've talked about a lot already. Agents are essentially using it to describe home listings. It's actually, I wanted to pull this one out because it's a perfect example of something ChatGPT is really good at. It's a formulaic writing task. And it's exactly the kind of thing that ChatGPT is not only structured to do well, it's structured to do fast. And that kind of brings us to the last thing, which is customer service, which has some overlaps with PR, marketing. These are tasks where efficiency is important and where there is a lot of repetition. It's incredibly formulaic. For instance, if you're writing FAQs or if you have common problems, how to solve them. Now, it's important to say for any of these, ChatGPT is not necessarily reliable. Nobody is talking about it as a replacement to humans on the record yet. And it should also say that these answers can be stiff or they can be confidently inaccurate. I wanted to come up with some examples for you, and this is the punchline. But ChatGPT was too busy to take my call this morning. So unfortunately, I don't have examples for you. I was disappointed. I thought we really had something. But they left me with a lovely poem. So I believe that will be up on the screen at some point soon.
Okay, all right. So as we're waiting for this poem, I just got to know, because we're also waiting for this to be monetized by a lot of these companies too. I mean, what that real runway looks like for them to be able to not just introduce these skills to the public or this generative AI to the public, but how they make money off of it.
It's a really good question, Brad, because I think the reality is we don't really know. And I think it's going to vary across industries. For instance, also there's the time is money argument in the case of the efficiency that something like this would require. I think that's hugely appealing. But I think in the case of healthcare, in the case of real estate, there's so much we still don't know. And that's sort of where the nervousness, I think, comes in for a lot of workers, for example.
All right, Yahoo Finance's own Ali Garfinkel joining us here on set. Thanks so much, Ali. We appreciate it. Stay tuned later today. Yahoo Finance's Dan Halley going to join Shauna Smith and Dave Briggs for a conversation with Microsoft's head of devices and search, 4:10 p.m. Eastern Time. You can catch it right here. You don't want to miss it. And coming up on the other side of the short break, taking flight, we're going to speak with Delta's Chief of Operations on the company's new jet engine servicing center. There you see him on screen. We're going to speak with John on the other side of the short break. Delta Airlines is celebrating the opening of a new repair shop in Atlanta, Georgia for Pratt & Whitney GTF engines that powers Delta's fleet of jets and those belonging to its maintenance, repair, and overhaul customers. Here to discuss this latest investment to bolster the Delta infrastructure and resource is John Lauder, who is the Delta Airlines Executive Vice President and Chief of Operations. We've also got for the conversation along with us, Yahoo Finance's Pras Subramanian. Gentlemen, thanks so much for taking the time here with us on the day. John, just to kick things off here, into this partnership and what really led to this, especially as you look through the fleet that Delta operates right now.
Well, first of all, thanks for having us here today. It's a great day at Delta Tech Ops as we open this new engine shop. And this is just the continuation of our Tech Ops team's advancement into the next generation engine platforms. So it matches well with our fleet. It powers our newest A321neo airplanes as well as our A220 aircraft. But it also gives us another chance to show the world what we're capable of doing for over 100 airlines around the world.
Hey, John, Pras here. So not only is it going to service Delta planes, but also other customers, other airlines, and it's sort of an additional revenue stream for the company. Isn't that right?
That's absolutely correct. It's something that we have been investing in for more than 20 years, is growing our third-party capability. And so you're exactly right. This is another revenue stream for Delta.
What type of contribution to revenue do you believe that this will be, John?
Well, I'm really not prepared to talk about that today. What I am prepared to say is that this is an engine shop that will do more than 10% in this first year of the engine overhauls on the GTF engine. And we'll have the capability to expand to well over 400 engines a year when we get up to full capacity.
Hey, John, so the MRO business, I mean, in terms of what Brad was talking about, what are some of the margins we're talking about in terms of servicing? Is it much higher than, say, usual operations with flights?
The margins, is that what you're asking about?
Yes, correct.
Yeah, the MRO business is good, and particularly when you have a group of people like I'm fortunate enough to work with here that are the developing high tech repairs, working with the technicians on the next level of repair that we can do to engines, engineers investing in time in developing repairs. And that's what really makes this a good business to be part of.
And when you speak about that time and making sure that the repairs are done so swiftly and getting these aircrafts back into the fleet and into the skies as well, what type of turnover is this going to really kind of, I didn't want to say, what's the delta around this turnover from previous operations to now, but what is that change? What's the net change as a result of this investment?
Well, there's no doubt that, one of the benefits to us being in this business is improving the reliability of our own fleet. So again, having the high-tech workforce that we do that is involved in turning these engines, there's two things that you do. One is through process, you get them off wing, repaired and overhauled, and back on wing faster, meaning you need to own less additional spare assets. And then also the ability to develop high-tech repairs. And so both of those things together are what really increases or separates us from others.
Hey, John, so just looking at it from your point of view, operation standpoint from 2020 for this year versus, let's say, pre-pandemic, how are things looking? Is the business still kind of growing, or is it bigger than what it was before we had the pandemic?
Yeah, so I mean, overall, you know well the story at Delta and the airline industry. And so the entire industry took a small step back as we entered the pandemic, just with uncertainty, but that rebounded very quickly starting in 2021. And then we saw 2022 continue to build as people put their aircraft or airlines put their aircraft back into service, including Delta. And so I think it's really back up to the level that we saw it pre-pandemic and continues to grow.
And when you think about the number of planes that are part of that operation right now, if there was a percentage of planes where you're looking to see some of that churn as you're moving into some of the delivery of new orders that you've already placed, and a lot of the industry has been tracking some of those orders that have been made either into Airbus or into Boeing, especially over the past 2 years, what is that percentage of planes that you see being sunset, those that are going to be serviced, and then those that are anticipated to be taken on and infused to the operation?
I'm not sure I can give you the exact numbers or percentage. What I'll tell you is Delta Tech Ops is going to be uniquely positioned. There are three next generation engine platforms. So one is the Pratt & Whitney GTF engine that we're celebrating today. Delta is also in the Rolls-Royce Trent engine, and we will soon be in the CFM International LEAP engine. And those three platforms are really what the future deliveries are about. These are the new, efficient, quiet, fuel efficient, fuel savings, next step in sustainability engines. And Delta is going to be the only shop in North America that can handle all three of those platforms.
Delta Airlines EVP and Chief of Operations John Lauder alongside Yahoo Finance's Frost Subramanian. John, look forward to hearing more from you and the team around this advancement. Appreciate the time this morning.
Thanks so much for having me.
Absolutely. Guys, coming up, Bed Bath & Beyond amping up its efforts to avoid bankruptcy. Sazi has his take next.
Bed Bath & Beyond attempts to avoid Chapter 11 bankruptcy filing with plans to raise around $1 billion from a preferred stock sale. Will this be enough to keep the battered retailer afloat? That's where we find Sazi's take today. Saz, the company came out with the pricing of this offering this morning. It's a pretty complicated raising of money.
Yeah, so let's try to just decode this in its very simplest form. So here's some of the funding allocations or aspects to this deal. First up, Bed Bath & Beyond getting, let's say, about $225 million up front from this offering. It stands to gain another $800 million over time. Also receiving another $100 million loan from Sixth Street Partners, a company or investment firm that had already given them a loan. So you're probably now wondering, why is the stock absolutely crashing close to 50% on this news? Essentially, Bed Bath is diluting its current shareholders by offering these additional shares. That is this in its very basic form. Now, we saw shares really explode yesterday, close to 100% on just speculation that this type of financing was coming to pass. But this does not mean that Bed Bath & Beyond is suddenly now a healthy retailer. It will be using these funds to pay down interest on a loan, on a JP Morgan loan it defaulted on. It will be using this money to pay down other forms of debt, and it has a lot of debt on its balance sheet. And then whatever's left over, Bed Bath is hoping that it can fund its transformation. Realistically, there is no transformation. The money that does have left over will likely be used to buy inventory to restock its shelves. That's first. And then secondarily, start to position the company to maybe have a holiday season this year to some extent. So all of this is a very, very tall order. But at least today, some of these offerings and this cash raise will avert or push out any potential bankruptcy filing. But by no means is this a healthy retailer on the verge of some type of major comeback. That's just not the case.
And even in the restocking of shelves, much of that and the revenue that they do bring in is really just to continue the operations in order to then pay back some of what they still owe to other debtors as well.
That's correct. So far the take here, and this might even echo what I said about Bed Bath last week, so I'll just re-up this one. The end is still near. It is a fundamentally challenged company. Anytime you see a retailer, their sales down 20, 30% over the course of several quarters, it tells you there is something mighty, mighty fundamentally wrong with the company. I will say this again, Bed Bath remains a zombie retailer. The lights are still on, but it remains borderline irrelevant.
Yeah, so it's always interesting when we see in this situation the shares spike like they did yesterday. Yes. And then plunge like they did today. You know, obviously there's probably professionals in there who are trying to trade the very small increments when the stock moves, but if retail investors getting in there, it's a tricky thing to trade.
And I'll just add this too. So this money will be used to buy inventory because we've seen, and I've certainly seen it from these Bed Bath stores, the shelves are bare in a lot of these stores. So this money will be used to restock these shelves. Then what happens next comes the summer and the spring. Once this money was used to buy new merchandise, do you have more money to continue to replenish your shelves? And then, oh yes, you still have an entire vendor community very concerned about getting paid. What rates of interest are they charging you to get and buy that inventory? Probably very high.
Yeah, because in some cases, it's not that they're paying new money for new inventory. They're paying vendors for unpaid bills. For inventory that was either already delivered or not delivered, right? So they're on the back foot.
Yes,
clearly.
if you're
they're
a vendor.
behind.
Yes, if you're a vendor that, let's say, sells coffee machines to a Bed Bath & Beyond, you probably still don't trust that you're going to get paid back. So what do? You raise the cost of goods on a Bed Bath & Beyond. And it's not just the coffee maker. It's probably every other vendor in this store.
All right, well.
I wish I had good news for you. I do. I mean, I like getting towels there, and I wish I can continue to get my towels there, but I'm not hopeful, guys. So I think
you're going to have to find a new towel vendor.
I like Target. Target towels are good.
Okay.
Very soft on my skin. Very soft on my skin.
All right, we've got some other towel suggestions.
We got you.
Coming up, One United Bank is introducing a surcharge-free ATM network. We're going to speak with the company's president next. we heard from the Fed that disinflation was happening.
Do you see disinflation?
Prices are not stable.
There's inflation, there's deflation, and there's disinflation, right? Inflation is when prices are going up.
Real wages have declined in the face of inflation, and it means that workers are still trying to keep up.
Clothing, housing, gasoline costs.
Deflation is when prices are going down.
We've seen the deflation in the pipeline. Some of the leading indicators that caused this spike in inflation, and we think it was primarily supply or shock induced. Some of those are unwinding.
Disinflation is when prices are going up at a slower pace.
We're now seeing some disinflation. That's mostly correction in the supply chain.
Disinflation decoded. It's used to describe the slowing pace of inflationary pressures. Look at it another way, it is a decrease in the percentage change in inflation. It is not deflation. Rise in the stock market and housing prices during the pandemic may have given older workers the ability to retire early at higher than expected levels. That phenomenon, along with other demographic changes, are contributing to an imbalance in the supply and demand of workers. Yahoo Finance's Inez Ferre has the details. Inez.
Yeah, guys, and it's really interesting to see these demographic changes that have been going on for a while now, even pre-pandemic. Jerome Powell has talked about the tight labor market, about the labor shortage of about 3.5 million people, and the labor force participation, which sits below that of February of 2020. So there's about 2 jobs for every unemployed worker. Now, part of this reason is because of excess retirements during the pandemic. Asset prices were going up. People felt like they could retire early. Also because of health issues, people retired early at higher levels than expected. You also have what's called the decline of prime age working men. And there's an economist, Nick Eberstadt, who I spoke with at the American Enterprise Institute. He's been studying this for decades now. And since the 60s, we've seen this decline of prime age working men. And that part of that has to do with government programs. Part of it has to do with the type of labor, with technological changes, health issues. Also, people with criminal backgrounds are less likely to be employed. And then the other factor that's going on also has to do with immigration. So immigration changed also during the pandemic. You had a large outflow of immigrants also going back to their countries. So immigration, it's a little bit tougher to dissect, but nevertheless, economists are saying that it could account for about 1 million workers. That's a shortage of workers. Why is this important? Well, because when you have a sort of slowing population, when you have 25 to 55-year-olds who are the ones are supposed to be working more, they're forming families, they are the ones that are working for the people who are older in the economy, so to speak, the people who are consuming less, the people that are on fixed income. So when you have this slowing labor force participation, that impacts eventually GDP, it impacts output, and also the amount of people who are paying taxes, that are paying for those programs for those for the elderly.
Well, and it's also interesting when you look at the demographic differences in unemployment among age cohorts, among race cohorts, et cetera. There are some big gaps, right? And big differences.
Huge demographic changes among the cohorts. And I will say also, we can't underemphasize enough the fact that during the pandemic, you saw asset prices go up, you saw house prices go up. In fact, the St. Louis Fed came out with some figures saying that from January to October of 2022, when asset prices went down, they saw about 170,000 people from the ages of 51 to 65 returning to the workforce. So, look, as the economy slows further, yes, economists are expecting that more people will enter the labor force. They will be forced to enter the labor force. But will they enter it to fill all those positions that are unfilled, more than 10 million positions? We're not sure that it's going to get to that.
Right, definitely. So still robust labor market as we watch all these dynamics. Thanks so much. Appreciate it, Inez. Good stuff. Well, One United, the nation's largest Black-owned bank, is getting rid of ATM fees at a network of 100,000 ATMs at participating Chase and Citibank locations, plus retailers like Target, CVS, and Costco. One United President and Chief Operating Officer Terry Williams is joining us now to talk about why. Terry, thank you so much for being here. ATM fees are a way for banks to make money, right? Why are you guys getting rid of it, and sort of what was the impetus for this move?
Yeah, well, first of all, thanks for having me. And yeah, the impetus was really listening to our customers. They, sort of these ATM fees were, some would call them nuisance fees. They were saying, why should I pay to have to take out my own money? And we sort of listen to them, and particularly in our community, we serve a lot of, low to moderate income families. And so those ATM fees really add up. So we're really happy to partner with Citi and Chase, but we also added to that ATM network that they offered and partnered with a whole retail network. So we're now up to 100,000 surcharge-free ATMs. And, the good thing is that they're located in the communities where our customers live. So, CVS, Walgreens, you mentioned Target. I like their towels too, by the way. But other locations that are located in our community, and that was important to us.
I've got too many towels and bath mats from Target as well here. Terry, great to speak with you. When you talk about some of the policies that you've been able to move forward with at One United that kind of strengthen that customer relationship beyond perhaps the microtransactions that may take place within each customer's account, where do you think about the efforts to help build wealth for a lot of those customers even further down the line? Once it's, okay, we've mitigated any type of risk for a transaction fee or an overdraw fee or withdrawal fee, now we need to think about how you kind of build on top of what you do have in this account.
No, that's a great question. First of all, our goal is to make financial literacy a core value in the Black community. And so part of what we offer are all kinds of financial literacy tools, podcasts, videos, even modules that they can earn points. So that's one of the things that we focus on. We also focus on savings. We have a, Keep the Change automatic savings program. We focus on the importance of saving and building wealth. And then, we also have money management tools that provides insight, spending insight, insight about, maybe it's better to pay down this credit card bill than to, sort of buy something new. And all of those tools are available in our app. We have what's called a super app, our mobile banking app. And all of those tools, whether it's financial literacy, money management, auto save, are available in our app.
Mm-hmm.
And Terry, we've seen over the past few years the rise of sort of a bank black movement, right? How has that affected you guys? Have you seen a big growth in deposits? And what is sort of still holding that back to some extent? Because we have not seen any of the Black-owned banks reach the same sort of tier of deposits that we have the more traditional white-owned banks.
So, first of all, it is continuing, and we continue to attract new customers and new depositors. We're also getting a lot of support from corporations that see, as part of their strategy, an opportunity to make deposits in Black-owned banks and to provide, such as Citi and Chase, other types of services. So we definitely see a lot of support in the corporate world as well as in the community and consumer world. And I think the movement is just beginning. I always say to people, we're 50 years old, but if you look at, these other banks, Wells, they're like, several hundred years old. So it really is just a matter of time before, Black banks really grow to the point where they are, we are significant from a financial services standpoint.
And just briefly within that as well, you have to recognize the fact that when you do have a bank that is hundreds of years old, there is a role that is played within the disenfranchisement of some of those customers now that have been looking for financial services solutions. What role do banks play more broadly in closing the ethnic and racial wealth gap?
Yeah, thank you. That's an important question. So there has been a history of banking in our community that hasn't been good. If you look at, whether it's redlining, even financing, I hate to say the slave trade. So our community doesn't have a long history, good history with banks, and there's a lot of mistrust. We see ourselves as being a bridge to the banking industry. We still have a huge percentage of our population that is unbanked and sort of getting them into the banking world. But then in addition to that, we do have a role. Banks in general, not just Black banks, have an important role of really addressing this head on, addressing the racial wealth gap. and that's providing home loans. Home equity is a huge contributor to the wealth gap. So doing a better job of providing home loans, as well as capital for small businesses. You know, we launched actually a small business loan program with Lendistry. It's a Black-led fintech for the purpose of really getting business loans into the hands of Black-owned businesses. So, I see the opportunity. I see, the movement forward as progress, but we still have a long way to go.
One United Bank President and COO, Terry Williams. Terry, thanks so much for taking the time here with us today. Really appreciate it.
Thank you for having me.
Certainly. Coming up, Nintendo is boosting its wages in Japan. We're going to share the details on that next. Welcome back, everyone. It's time for Cup of Time. 3 stories, 1 minute on the clock for each. We're going to start with this today. Yes, get those gaming fingers ready. Nintendo boosting salaries amid a tight labor market. The gaming giant says it plans to raise payment for its workers in Japan by 10% beginning this year. Shares are flat, just barely to the upside for Nintendo as of right now, but thinking about the tight labor market, especially within gaming, this is where they're trying to retain developers. They're trying to make sure that the titles and then the consoles that they continue to put out just attract that fanfare among so many gamers that have a multitude of options out there.
And by the way, they cut their outlook today, too. So unlike so many of the companies here in the U.S. that are touting their cost-cutting, Nintendo here is recognizing that within this tight labor market that they need to hire to grow, or at least pay more to grow, yes. Right? So it's interesting.
Did Nintendo confirm that Mario and Luigi getting a pay raise too? Big fans. I mean, because they could theoretically, maybe they jump to other platforms. I mean, you got to keep key employees
they
like that
literally jump to other platforms.
They literally could jump to other platforms, yeah. Just creating this stuff
Hopefully
in real time.
They got a cut of the movie revenues.
Yeah, well, I'm rooting for them. I hope they got some more money. All right, Panera is launching a new accessory for your wardrobe, the baguette. The item is launching ahead of a big week for the fashion industry and is intended to hold the company's newly created toasted Baguettes. I have to drop a line to Panera founder Ron Shaich, just my longtime friend. I'm just curious. He's no longer involved with Panera, but I'm just curious on what he thinks of this. As for me, it's in Panera Green, so they hit that point. It looks to be maybe leather, maybe hit that point, and they make good sandwiches, so why not protect them? It ain't Subway. You don't want to put a Subway sandwich in there.
Does it keep the sandwich warm? I wonder. Does it have like some of the features of one of those pizza boxes?
Oh, like the Domino's pizza box.
Did Luigi get a raise? I mean, it's unclear to me. Do
you think this is going to be the hot fashion accessory in Fashion Week?
It should be.
Can you see Anna Wintour?
Just don't put that Subway tuna sandwich in there. No. You don't want to do that.
You don't want to put the Subway tuna sandwich anywhere.
Anywhere, especially in your stomach. Yeah.
I'm just going to say that Zazie really could have used this in that episode of Atlanta where she run around with a baguette. And anybody who's seen Atlanta in that episode particularly, they know. She could have used one of these.
Good invention.
And there's one space that will not be making an appearance at the Super Bowl this year. I think you can probably guess it. It's the one that was all over it last year, crypto. After a slew of ads from FTX, Crypto.com, Coinbase last year, the companies have not bought any ad spots at this year's big game. No surprise here, guys. I was even sort of jolted by seeing a bunch of Instagram posts from the Grammys that had the location as Crypto.com Arena, because I had momentarily forgotten that the Staples Center was renamed Crypto.com and still is named Crypto.com Arena.
Still is, indeed. I mean, so many advertisements that we saw from crypto, and it really populated and dominated the airspace time in every kind of commercial break that we saw last year's Super Bowl. This year, it's just a kind of toss-up, and it'll probably revert to the same type of companies that we've become. Beer, Tostitos, probably, maybe a couple music streaming services here and there.
I'm really excited how Apple shows up. It's the halftime show.
They are.
Sponsor No More PepsiCo, which reports earnings later in the week, but I'm just curious. I think they can steal the show. I'm very curious what they have planned.
Bad gal Riri, she'll definitely steal the show.
Yes.
It's really just a Rihanna concert that happens to be flanked by football.
A football game, right?
Yeah.
That's true.
All right, that does it for us, you guys. We are anxiously awaiting those comments from Jay Powell. And in the meantime, tune in for Rochelle Akufo's interview with the CFO of Royal Caribbean on the back of that company's earnings report. We've got mixed markets here. Keep it right here.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Jay Powell's speech in the noon hour will set the tone for the trading day, but we'll speak with a strategist who says there's already been some key Fed speak you can't ignore. Find out why you shouldn't fade the Bostic. And it's in the charts. Bitcoin awaits the Fed chair as well, but some technical analysts seem to think it's already screaming signals you need to pick up on. We discuss the golden cross chart pattern and what that could mean for you. And of course, President Biden's State of the Union will steal the headlines tonight, but with a myriad of issues from inflation, immigration, police reform, and security, where is the American public's focus? We deep dive this hour. But first, let's take a major look at where the major indices stand an hour and a half into the trading day. A mixed picture, though, but relatively flat. We've seen both the Dow and the Nasdaq sort of vaguely just bobble into some positive territory, but still flat at the moment. The Dow there down about 0.5%, the S&P down about 0.25%, and the tech-heavy Nasdaq just barely in the green there, just up a fraction. We're seeing that consumer staples, in particular, dragging down the sector action. Let's also check in on the Treasury market, always looking for signs of what the Fed may do and any hints of recession. You're seeing that the shortest term 5-year there, down 0.03% there, the 10-year and the 30-year. Positive territory though, the 10-year up there just fractionally, about just barely 1 point, and the 30-year there up 1 point as well. All right, well, Bitcoin making moves that may signal a move towards highs, but the future picture of the crypto token remains muddy. Now, this is as investors keep an eye on comments from the Federal Reserve Chair Jerome Powell this afternoon. So here to discuss is Yahoo Finance's Inez Ferrer. Inez, a lot to watch here for crypto. It's certainly changed a lot.
Yeah, that's right. And Bitcoin bulls have been talking about the golden cross, which they saw yesterday. So we have a chart that we want to show you. This is the chart for Bitcoin, but we want to show you a full screen of that golden cross. And the golden cross is when the 50-day moving average crosses above the 200-day moving average. And we saw it here yesterday. We also saw that happen in September of 2021. And so that's afterwards where you hit the all-time high. So it's a bullish signal. Now, the contrarian to the golden cross is the death cross. That's where the 50-day moving average crosses below the 200-day moving average. And the last time that we saw that was in January of 2022. So if we just pull back the Bitcoin chart that we have on our touch screen, on our interactive board, you can see here, I'm going to pull up Bitcoin over on here. It's right now down 0.3%, but this is a three-year chart. And you can see the move to the upside after that golden cross, and you saw the golden cross here yesterday. Again, this is a bullish signal, but not all of the times, because when you have choppy trading, it may be a false signal. And to put it in Jerry Blickery's words, my colleague here, he said, moving average crossovers are great for long-term trend following, but if there's no trend, you get chopped up. Now, what I like to look at is the US dollar index, because oftentimes we have seen that when the US dollar goes up, you see asset prices go down, and that's when you see also we've seen Bitcoin pulling back as well. But certainly this is something to talk about among the bulls. Rochelle?
Indeed. Inez Ferrer, thank you so much. All right, well, as digital assets try to climb back after enduring several pain points in 2022, there are still dozens of crypto firms rummaging through the implications of last year's cryptocurrency collapse. Well, here with the latest on the state of the crypto industry is Yahoo Finance's David Hollerith. Hey, David.
Hey, the bankruptcy of crypto broker Genesis has been a major focal point in terms of where the industry's headed. Now, on that front, the case has implications for two major players, cryptocurrency exchange Gemini and holding company Digital Currency Group. DCG is the largest borrower of in Genesis's bankruptcy, and Gemini has about 340,000 customers who have become Genesis creditors.
All right, we appear to have lost David right there, but we're going to bring in our guest here now because, I mean, the hits to crypto seemed never-ending in 2022. And, of course, to add salt on the wound, crypto saw the biggest year ever for hacking as well, with $3.8 billion worth of stolen cryptocurrencies. This according to a new report from Chainalysis. So here to break down the crypto hacking spree of the last year, and, of course, the way forward for DeFi is Erin Planty, Chainalysis VP of Investigations, in this segment brought to you by Intuit TurboTax. Good to have you on the show, Erin. So you've noted that in the study by Chainalysis. Good to see you too. Now, on top of what we saw with the scandal from FTX, though, in terms of hacking, we also saw bumper numbers last year. Why did we see that? And we also saw some spikes as well for March and October. What was driving 2022's hacking spree?
We did. Last year, 2022, was the largest year ever for crypto hacking incidents. The largest months were March and October. March was largely driven by the large hack of the Ronin bridge, which is the bridge that powers the Axie Infinity gaming platform, which seized over about $600 million. So it was a very large heist. October was a significant month in many hacks in general. There were over 30 hacks that month, and it made up the largest month ever for hacks. The scale of the hacks is definitely significant. There's been a large number of attack vectors, including kind of age-old phishing tactics and installation of malware. And we have seen a very large uptick in DeFi exploits as well, where the code of the smart contracts is manipulated itself. And the largest hacking perpetrator is North Korea. They had a banner year in 2022, about a four-fold increase from the previous year. And they made off with approximately $1.7 billion, which is a significant increase from years past.
So Erin, let's break some of that down. I want to start on North Korea there, because they do appear to be at least the most prolific actor in this space, according to that report. What is unique about those attacks, and where is the money going? Where is it flowing to after the hack?
They've had a lot of success in the past years in hacking cryptocurrency platforms, and that success has brought them fairly significant rewards. And that success has also led them to put more resources on hacking. So the escalation this year is major, and they're attacking from a lot of different ways. They're leveraging the same malware that they've leveraged for years, but they're also looking for new avenues, looking to exploit DeFi protocols. They're looking at server exploits, a lot of different ways that they can make off with crypto. And research shows that those funds are being used to evade sanctions and ultimately fund their weapons of mass destruction program. So it is quite alarming from a national security perspective.
So then what makes a system an easier target than others?
DeFi protocols have been significantly hit this year. It's a newer technology, and they don't have as much of a focus on cybersecurity, although that is changing. And with any new technology, there are vulnerabilities that exist. It has a lot of new innovations. It has a lot of new use cases, and DeFi in general is newer in this space. So it's prone to more vulnerabilities. And we've seen that with the exploiting of the smart contracts themselves to steal money directly from the protocols. We've also seen a significant increase in funds stolen from DeFi bridges. And the Ronin bridge and the Harmony bridge are two hacks that drew quite a bit of press this past year. They were both quite large in size, particularly the Ronin bridge. And they also had very similar attack vectors. Bridges in nature have a significant amount of liquidity because they are connecting proprietary technology to other blockchains. So at any time, there's a large number of assets that need to be funded across these bridges. And so there's typically a large number of tokens and assets that sit within that bridge with a large amount of liquidity so that it can handle all of the exchanges that go through the bridge.
So then what does that mean for your outlook for 2023? And if you are a crypto investor, or you use some of these platforms, or you're a company that works with some of these protocols, what are the concrete steps people should be taking to protect themselves?
There is a much larger focus from a lot of different angles. The cybersecurity focus is definitely key. So there has been a significant increase in cybersecurity companies focusing on this space, as well as some of the newer innovations in the DeFi platforms to also look more deeply at cybersecurity, because we want to stop the attacks before they occur. But there is also a need to focus on the money laundering itself, because if we can stop North Korea from ultimately converting their stolen crypto to cash or to other mechanisms that they can fund their missiles program, that makes it a lot less lucrative for them. So there has been quite a bit of regulation, quite a bit of policy. We've seen 2 sanctions this year of mixers that were an attempt to stop some of the avenues for money laundering. And there has been a significant effort by public and private sector companies to tackle the funds that are flowing through various services for the purpose of money laundering. And there's been some successful seizures of North Korea funds, and those seizures continue to increase. And it's largely due to a heavy focus by private sector companies as well as public sector companies.
We'll certainly be keeping that on our radar. Erin Planty there, thank you so much. Chainalysis VP of Investigations in this segment brought to you by Intuit TurboTax. Thank you for joining me this morning. All right, well, let's get back to our very own Dave Hollerith about the state of the crypto industry. Obviously, David, a lot going on.
Yeah, the point I was going to make is Genesis, the bankruptcy of Genesis, the crypto broker, has had big implications given that it involves 2 major players, cryptocurrency Gemini and holding company Digital Currency Group. Now, for the past 2 weeks, sort of negotiations and progress for the bankruptcy had sort of been stalled, given that the parties couldn't come up with any sort of agreement. DCG is Genesis's largest borrower. It's also its parent company. Gemini has about 340,000 customers who are now creditors. Now, yesterday, sources and later Genesis lawyers in a Monday afternoon hearing said that all parties have finally reached an agreement. Now, this agreement is important because it gives DCG more time to repay its loans. It's the agreement, while it's not fully fleshed out, involves cash, Bitcoin, and later payments in equity in DCG or one of its subsidiaries. So at least on the surface, this looks like a win for both of the companies. Previously, their billionaire founders had been sparring over Twitter publicly. Gemini, for its part, is going to kick in about $100 million into the proposal to repay its customers turned creditors in this situation.
Certainly a story we'll continue to follow. Dave Hollerith, thank you so much for that update. Well, stay tuned later on today on Yahoo. Yahoo Finance's Dan Howley will join Shauna Smith and Dave Briggs for a conversation with Microsoft's head of devices and search at 4:10 p.m. Eastern. You won't want to miss it. All right, coming up next, tech stocks might be coming back under pressure. We take a deeper dive into the sector. Stick around. Tech stocks might be coming back under pressure. Citi reporting that bets on the end of the rally in the Nasdaq are rising. Here with more, Yahoo Finance's Jared Blickery. Obviously, after what we saw to the start of the year, it's going to be a tough break for tech at the moment.
Yes, it is. And by the way, we still are in the best year since 2019, best start to a year, about 25 days, trading days in. That's pretty significant because it is the market reversal from last year. And I'm looking at a note just in broad strokes today, Citi noticing that there are bearish bets on the Nasdaq being placed. And let me just show you what a one-year chart looks like. So we have this low that happened basically at the in the middle of December, and we have risen almost 20%. Now, some will call that a bull market, and we can discuss that in a second. But if, in fact, bearish bets on the market are increasing at a rapid pace, that creates a potential for a short squeeze. And that's another thing that Citi is noting. That means that shorts, people who are betting against the market, betting on it to go down, they have to cover their bets. They might have stops in place, whatever. When they get out, that fuels the rise to the next level. Accidentally changed to the Russell 2000. Here we are back at the Nasdaq. So all in all, with this potential catalyst that we have today, with Powell speaking at the Economic Club in Washington, D.C. at 12:40 today, he may be walking back or doubling down on some of the statements that he said that he came to last week. And let's take a look at the price action from last week. Now, this is a 3-month chart. So here is that big green candle. This was last Wednesday, and that was the highest point in several months there. Now, when that happened, a lot of people were a bit surprised because a lot of people noticing also that the Federal Reserve doesn't necessarily like it when the stock market is up, especially on these big Fed days when they're trying to convince the market of their hawkishness. Nevertheless, a lot of market participants interpreted that day as dovish. So we exceeded that to new relative highs the following day, and now we have come off quite a bit, especially with that hot payrolls number. So today could provide the Powell the opportunity to get a little bit more hawkish, or just to reaffirm the market participant, their notions of his dovishness would be reinforced from last Wednesday. Also want to point out that the U.S. dollar has been getting strength over the last few days, so that's another metric that I'm going to be looking at. But here are the leaders in the market that we've seen since the beginning of the year. Bito in the upper left, I'm using that as a proxy for Bitcoin, followed by meme stocks, followed by the ARK Invest, that is the disruption sector right there, followed by chip stocks. All of that I would expect to see a momentous rise if we were to exceed those prior highs in the Nasdaq. And again, I think that's going to come down to this potential catalyst we have with Powell today in just a little bit. So we'll have to see if that happens. But again, it comes down to definitions sometimes, Rochelle.
And to that point, Jared, I mean, we talk a lot about when the bearishness ends and the bull market begins, but let's take a step back here into how we actually define a bull market.
Yeah, let me point something out, because there is no universal defined bull market that everybody agrees on. Now, if you're just saying the market has risen 20% off of its low, we are almost there right now. But guess what? In the Nasdaq, this happened last June or so. We saw a 20% rise, and guess what? That 20% occurred at the very top. So there were some headlines in the middle of last year saying, oh, Nasdaq and new bull market. Does that give the all clear? Certainly not in this case. And you go throughout history, there have been a number of instances where it's worked out, and in fact, the majority of the cases it works out, where if the market is up 20% from the lows, it's going to continue along that path. But about 1 in 4 to 1 in 3 times, it does not work out well. And particularly in bad bear markets with recessions. We don't know if we have a recession yet, but we'll have to see. In 2008, we had a signal in December that was wiped out. Finally had a good one the next year. And in 2001, 2002, we had no fewer than 4 bad signals. So not necessarily the all clear. Watch out for those headlines.
Certainly, so a mixed picture indeed. Jared Blickery, thank you for that. Well, Atlanta Fed President Raphael Bostic's call for higher rates and more hikes, adding fuel to the bearish bet fire. But our next guest says not to be tempted to bet against the markets as a whole, but to be selective about sectors. Joining us now is Ben Emmons, Senior Portfolio Manager and Head of Fixed Income and Macro at New Edge Wealth. Good to have you back on the show, Ben. We know the mantra, don't fight the Fed, but you're saying don't fade the Bostic. Break down that argument for us.
Yes, indeed. Don't do that, because there's a lot of people out there that make the bearish bets purely on the Fed, and meaning the Fed may have to continue a bit further with rate rises, and then it should just simply bring valuations all the way down again. Now that interest rates have an impact on valuations is clear, that we've experienced it over the past year. The stock market had to digest a different Fed policy than we were used to over the last decade. But we're in an environment now where it looks like the economy is having, again, resilience. The jobs number was obviously explosive and really above anybody's expectation, including the Fed. So it does underscore that rising rates may be indeed needed, as Bostic was saying. But if you have a strong economy, that doesn't necessarily mean that the stock market should correct downwards. It should actually be up. And I think that continues to be the theme this year, because a strong jobs market signals no recession. So why should stocks then be down? So I think for that reason, you don't fade Bostic, as I said. You don't go, short the stock market because the Fed is raising rates. Rather, you actually stay somewhat more constructive but selective, that the market is in a good spirit here because of the economy being resilient.
And fade, just in case people aren't sure, means to take a contrarian view. But we know that Bostic told Bloomberg, at least, that he does expect a higher rate than projected. It could be an extra 25 basis point hike. It could be a pause and then a hike. They even said not taking really a 50 basis point hike off the table, but he does support the downshift that the Fed is on. What is Powell going to have to say today to really perhaps get things back on track? Because once you mention disinflation more than a dozen times in a press conference, markets hold on to these things.
And that's for sure. And I really agree with you on that, is that, the moment he mentioned that word disinflation, it was coming from Powell himself as an official confirmation that the Fed now really believes that the economy is experiencing disinflation more consistently from here. So that message is in the market's mind. And that is connected with that there's another view in the market that thinks, okay, if you are in disinflation, you do not have to hike that much anymore. If anything, you may be able to cut rates. Now, that too has changed since the jobs number. And I think that too is what Bostic was alluding to, is that, no, we cannot really cut rates, but we are in an economy where if we have strong job growth, we may have to raise rates several more times to then get to this outcome that we do end up with inflation being more moderate than what we've seen last year. So Powell has to thread that needle today in this conversation with David Rubenstein. I do think that he will stick to that point, that he says, yes, the process has started, but that job is not done. And he does try to echo what really the messenger Bostic is saying currently. You cannot really cut rates. You have to continue to raise rates several more times to get to a rate that does lead you to a more consistent disinflation from here. I think that's what he may emphasize today.
And certainly that jobs number, even though it was a strong jobs number, some nuances in there, not just seasonality, but also some population changes that the BLS also factors in specifically to January reports. But I know that is the main factor, at least that was for markets. But what are some of the other factors you think that the markets are not pricing in that might keep the Fed in more restrictive territory?
Well, if you take, for example, overnight, you had the Australian Central Bank coming out with a really interesting statement about their situation. It's a country that's closely linked to China. And as we're all watching the China reopening impacting the globe, Australia is one country where the effects show up first. And the Australian Central Bank decides to hike rates as expected, but signaled they may do more rate rises because they see global factors, as in China factor, affecting their domestic inflation. Now, this will be something that will be on Powell's mind too, because it's not just a really unique situation here in the US, given certain maybe categories of goods that are driving up our inflation rate. It's really what's happening globally. If China reopens fully, we all know that's going to impact demand for commodities, going to impact demand for energy. So it does lead you to also calculation in, I think, Powell's mind that whatever comes out of the China reopening, it does lead to pressure on prices. So that too, you therefore cannot relent at this moment in your federal, in your monetary policy, meaning too quickly going from tightening to easing. So I think that that's something that the markets is still trying to grapple with. There's a lot of expectation about China boosting maybe global growth, but it's unclear what inflation will do from here. I think that Powell takes the cautious side on that front and says, we do keep in mind that could drive up inflation again, and therefore stay vigilant on interest rates.
And it's interesting because as Jared was mentioning some of the sentiment that's actually been doing well this year, things like some of the tech stocks, some of the ones that need to turn a profit, meme stocks, cloud and things like that, you're actually saying that if you're going to fade anything, it should be those. And you included ARK in that as well. Break that thought process down for us.
Yeah, I think it was a good diagram that your colleague showed. You saw in the upper left-hand corner, the real speculative, quote-unquote, speculative area of the market. And obviously that had done really, really poorly last year. And as people get excited about, hey, the economy may not be in a recession or other thoughts about the Fed may move to easing, whatever their reasoning is, the money came off the sidelines and found its way into the segments that you highlighted in that upper left-hand corner, with meme stocks, Bitcoin, and ARK Innovation. Now, these could be good investments long-term, but we also have to keep in mind that those are really liquidity-driven type movements that we're seeing there, as in money that was parked on the sidelines comes into these sectors first. And I think to an extent, as the money also went into China ETFs, it spilled over into that speculative sector there too. So I say, if you think about fading this rally, which seems a narrative out there, I say don't fade it because of the broader rally, given that the economy is not in a recession. But if you do want to take some fading, so to speak, then you may look at that speculative area. I mean, if you're up 30-40% already at the start of the year, some of that's quite high returns, I think, to start with.
Indeed, we see investors really still trying to search for some sort of direction and at least try and get off the sidelines, but with some caution here. Ben Edmonds, the Senior Portfolio Manager and Head of Fixed Income and Macro at New Edge Wealth. Thank you for joining me.
Thank you.
All right, coming up, President Biden will address the United States tonight. We'll discuss what to expect and take a look at his current approval rating. Stay tuned. President Biden will address the United States tonight at 9 p.m. Eastern. Now, he's expected to say the union is strong, but will his address move the needle on public opinion and get to the matters important to the average American? Yahoo Finance's Rick Newman has insight on what we can expect later tonight. Rick.
Hey, Rochelle. Well, we know President Biden is going to do more of what he's been doing lately, which is taking credit for what's good in the economy. That would be the labor market, incredibly strong, especially with that job report we just saw for January, 517,000 new jobs. I'm sure we're going to be hearing a lot about that. He's going to talk about inflation coming down. And then he's going to be touting a bunch of things that are sort of small ball, really. I mean, he's going to be talking about doing something about what they call junk fees at the White House. These are add-on fees to things like concert tickets and travel and things like that. There's going to be a lot of emphasis on healthcare. Biden's going to talk about new efforts to fight cancer, to deal with fentanyl and opioid overdoses, a new initiative on mental health. And then the rest of it we'll have to see. I mean, these speeches are typically laundry lists of things presidents want to get done. We do know that there's very little chance that Congress will actually pass any of the stuff Biden wants. He is going to talk about bipartisanship and the bipartisan bills he has been able to get passed during the last 2 years, but that is not likely to happen during the next 2 years since Republicans control the House. And most Americans won't watch. And they may hear a little bit about it tomorrow, but it's not going to change anything material about Biden's public image, which is relatively weak.
And I mean, Rick, to really figure out what people care about as well, Yahoo Finance conducted a poll. Inflation was the runaway #1 issue. We know that Paul Schatz of Heritage Capital said for him, for his clients, it was topic 1, 2, and 3. But also we're seeing international relations as you saw all this back and forth over China's balloon and alleged spying, but then also immigration actually beat healthcare in terms of the issues that they are expecting, or at least hoping that President Biden talks about. But to see inflation so far ahead of everything else, not really a surprise here.
So I think those poll results track very closely with what we're seeing in different types of data, such as consumer confidence surveys. I mean, so we have an unemployment rate that is almost as low as it has ever been. I mean, it's at a 50-year low, and that ought to be good news. I mean, Americans have the best job security many working people have ever had in their lives, and pay has been going up by more than usual, and yet we find that people are in a recessionary mood. Many people say the economy stinks. And you have to say, what's the disconnect here? And I think inflation explains a lot of it. I mean, we forgot how pernicious inflation can be because we haven't had meaningful inflation in almost 40 years until 2021. So now we have it. And even though inflation is coming down, it's down to about 6.5% from a high of 9%. It is still bumming people out. And I don't know if this is just sort of a shock effect that has not worn off yet, or if people still are going to the grocery store and the department store and saying, how did prices get so high? I mean, we know that, price increases in things people don't really spend that much money on can have this outsized effect on the way they think about the economy. Eggs are the latest thing. I mean, we've got 50 or 60% egg inflation. Most people spend very little on eggs, and yet they are really bummed out about the whole country because the price of eggs is so high. So consumer psyches are a weird thing, and politicians like President Biden have to deal with that. So Biden is going to try to figure out ways to convince people that things are better. I'm not sure he's going to do it, but he's going to try.
That's a tough sell because people might not be buying a new car every week, but they're certainly buying the groceries every week. And that does tend to hit home in a very visceral way for people. We'll be keeping an eye on that. Yahoo Finance's Rick Newman, thanks so much.
See ya.
All right, coming up, business travel software startup TripActions announced this morning it's rebranding itself. We break down the company's new name and updated outlook with its CEO. Stick around. Business travel software startup TripActions announced this morning it's rebranding itself as it integrates ChatGPT into its platform and will rename itself Navan. Now, in this move, Navan will ramp up its efforts to consolidate corporate travel and expense services into one single app, taking on the likes of expense platforms such as Concur. Well, joining us now to discuss Navan is co-founder and CEO Ariel Cohen. Good to have you on the show here. So you know that usually when a company rebrands, it really does tell you about where the company's headed, how it's evolving. What are the big takeaways in this rebranding for Navan here?
Yeah, first of all, good morning, and I'm really happy to be here. And yes, for us, we've done this journey in the last 8 years, and we believe that this is the time to really open up our platform for everybody. So it's the right time. And Navan is really about, it's a palindrome, so it's accessible for everybody, for everyone that are out there. And if you think about it, really changing the way that software works in the enterprise, bringing it both to the company and the employees, this is really what we are trying to do here with this entire rebrand.
So talk about this push then with generative AI technology. We know that it's grown in incredible popularity over the last few years, but really in the last few months, it seems like it's everywhere. How will people see that used in your products and services?
Yeah, first of all, there is something really magical that you can create today in the workplace. On one side, you can have the entire company meeting their needs, right? So if you think about it, you need to adhere to policy, saving costs, know where your employees are. But on the other side, you really want to service the employees. You really want them to participate in it. And this is really where new technologies like ChatGPT are coming into play. We really integrated chat 7 years ago. Then we added machine learning and AI 12 months ago. And actually today we are releasing a version that you can really support yourself by communicating with our chatbot, Eva, booking your trips, getting information of the locations that you need to go to, changing your flights instantly. So really hyper supporting you in one super app that every traveler and every company can use as of today.
I mean, in your press release, you say you're the first travel company to leverage this generative AI technology, but you do have a number of very large and well-known clients, as you can see there on the screen. What are the ways you plan on working with clients with this? And what are some of perhaps the risks that come with using a technology that it's still pretty nascent in terms of there's still some glitches, the chat GPT software doesn't always get it right, especially when there's some nuances?
Yeah, first of all, it's in our environment. So we have our own chatbot, Eva, that we started to use a year ago, and our users and our companies love it. Today, 30% of our interactions with customers is actually being done by Eva, and it gets the same satisfaction as if you would talk with a real travel agent. Now we're really taking it to the next level, and I'll give you one example so you understand how it works. Let's say that I want to book the Westin in New York. So a week ago, I would go to our app and I will ask, hey, book me the Westin in New York. And the app will reply, what do you want me to book? Today, as of today, when I will say, book me the Westin in New York, it would ask me in what dates. So this is really about context, understanding what the traveler wants to do and really taking care of it. So in our environment, which is different than what you see with ChatGPT out there, with our environment, it's all in the context of travel. And it's really about context and really makes it look like you are talking with a real person. Now, the cool thing about it, obviously, there are a lot of complex things around travel, whether maybe you need to book 5-6 cities in one trip and so on. So right now, what we are doing with our agents, we are really making sure that they are supporting our travelers for the complex stuff, while all of the normal stuff, the day-to-day stuff, is being supported by Ava, our new chatbot that is integrated to OpenAI.
So it does seem to be more of an assistive role, because everything that keeps going around says, ChatGPT will, it'll take your job, but it does seem to be taking on a more assistive role in this landscape. I want to talk about what you're actually seeing in terms of business demand, business travel demand coming back, and how you're positioning yourself then.
Yeah, first of all, we saw business travel picking up really, really quickly, and we're actually seeing it accelerating. And I think here is what's going on there. First of all, you have the usual use cases, the stuff that we used to do in 2019, salespeople, execs, interviewing employees. And now if you think about recession, companies need to focus even more on selling, on meeting their numbers. So we see that kind of activity. It came back to where it was before COVID. But on top of this, and we think that this is very much related to remote work, we see a lot of teams coming together, a lot of offsites, a lot of traveling to one place to meet everybody. So in fact, what we see in our platform, that business travel is actually bigger than what it used to be pre-COVID. It's also what others are saying. I know that the GBTA, which is the Global Business Travel Association, just published today that what they are hearing from companies is that they are planning to travel more this year compared to the previous years.
And certainly as everyone tries to find ways to cut costs and trim some of those margins, definitely something to keep an eye on. Navan co-founder and CEO Ariel Cohen, thank you so much for joining us this morning. Right, coming up, Royal Caribbean reported earnings this morning. We drop the anchor and welcome the cruise line CFO on board to break it all down. Stay tuned.
Tesla is raising the price for the Model Y after the U.S. government issued a rule change for its EV tax credit. Here's what you need to know. Tesla hiking the price of its Model Y long range by 2%, giving the electric vehicle a new price tag of $54,990. The price hike is coming on the heels of a significant rule change for how the government defines an SUV, allowing more vehicles to fall within the SUV category and still qualify for the federal government's $7,500 EV tax credit, even at higher prices. Tesla CEO Elon Musk has publicly criticized the government's eligibility rules in the past, and just last week met with top White House officials to discuss shared goals around electrification and advancing electric vehicle production. The adjusted guidance now caps the Model Y's eligibility for the tax credit at $80,000, giving Tesla a lot more room to run in terms of incrementally raising prices. The bottom line for consumers looking at EVs, you might want to order one now before prices rise again.
Well, from the road to the sea now. Royal Caribbean reported a fourth quarter beat before the bell this morning with smaller than expected losses. The company noted that since the middle of November, it's recorded its 7 strongest weeks of bookings in its history, and that's despite higher prices. For more on Royal Caribbean's Q4 results, let's get to the company's Chief Financial Officer, Naftali Holtz. Thank you for joining me this morning there. So talk about this quarterly report here. Clearly investors, when we saw what happened with the stock price reaction, very, very bullish on this forward guidance and what they've seen during that wave season in terms of what you've seen in those bookings since November.
Yes, good morning. First, it's great to be with you here on our beautiful Anthem on the Sea. And people here, the ship is full. They're going to go on an 8 amazing day vacation, including our Coco Cay private destination. And you can see everybody here is ready to go, very engaged. And it's really a reflection of what we're seeing in the book of business. We're seeing very high demand, very robust pricing, and people just really engaged and wanting to consume those vacations and seek those with us. So our bookings are accelerating at higher prices, as you said. We're continuing to close the gap to our revenue in 2019, and we're really excited about what's ahead for 2023.
I mean, you're making us all quite jealous there. You're out there in the fresh air, enjoying yourself on that cruise ship. I'm sure a lot of people want to be. In fact, you actually expect 2023 demand to outpace pre-pandemic levels. Now, is that still from pent-up demand or for people looking for perhaps more value in their travel? What do you attribute that to?
Yeah, so since a few quarters ago, we really saw an acceleration in demand. It's a combination of people just shifting their preferences for purchasing things to seeking experiences. Well, that's good for us. We're clearly in the experience business. Our value proposition remains very, very strong and very attractive. We think too attractive, so we're working to close that gap. And they just want to explore and get out there and seek the world. And we're here to make their dream happen.
I also want to look at this forward, the guidance you had for full-year earnings per share of $3 to $3.60 in 2023. So still some upside definitely to go there. Where do you think that growth is going to come from after this wave season, which wraps up in March?
Yeah, so we had a very strong, has been experiencing very strong wave season. It's an important booking window for us. We can't describe it anything other than a record-breaking season for us. So our bookings are significantly higher than 2019. We are getting back to our normalized occupancy levels at higher prices. So that obviously carries through to the revenue line. And we have more ships in the water, so we can offer better vacations. They're newer ships. We have significantly more activities on board. In the same time, we are very actively managing costs in what is a very challenging operating environment. So the combination of us growing our yields, growing our revenue, and controlling costs get us to a place where we're continuing to grow and increase our earnings. We're expecting the first profitable year since 2019, so it's a big milestone for us. And we're working really, really hard to get back to what we had in 2019 in terms of earnings. And we're very excited about what's ahead.
And we knew that margins was really going to be the theme of the earnings season. How has your team been able to manage costs in this environment?
Yeah. So the culture of and the cost outlook that you see is just a reflection of our culture. It is continuous innovation and continuous improvement. We've been working for over 2 years to basically reshape our cost structure because we knew that when we are coming back into service, we will need to be leaner and making sure that we're more efficient because we obviously had to raise debt and capital, and we need to make sure that we're generating more cash flow and more margin. So we've been working at it for 2 years, really across all the categories, really finding ways to be more efficient and better manage the cost, while really focusing on making sure that we are delivering on the guest expectations. And the reflection of what you see is that hard work of our teams for a very, very long time. And we will continue to do that. And we're finding ways every day to try to do a little bit better and a little bit better. And that's really what we're focused on.
Certainly has been a tough time, obviously, for the cruise industry. So good to see that route to profitability ahead. A big thank you there, Royal Caribbean's Chief Financial Officer, Naftali Holtz. Thank you for joining me this morning. All right, coming up, the Iger effect. We build up to a big report from Disney and touch on the ongoing activist pressure as well. That's up next. Disney's in the spotlight this week as investors gear up for the company's first report since Bob Iger made his return as CEO. So what should they be focused on? Yahoo Finance's Alexandra Canal joins us now with more. Hey, Ali.
Hi, Rochelle. And we just got the update, too, that Disney's annual shareholder meeting is going to be taking place Monday, April 3rd at 10 a.m. Pacific time. And this is going to be a big one because there's been a lot of activity surrounding Disney's board since Nelson Peltz launched his activist fight just a few weeks ago. And I think a lot of people are going to be closely paying attention since Nelson Peltz and his Tryon Fund have been urging Disney shareholders to vote against one director that Disney has heavily endorsed, Michael Froman, and elect Peltz instead. Peltz, of course, has heavily criticized Disney's heavy content spend, as well as their current succession plans, among other things, such as operational challenges at the company. Tryon has said that Peltz would provide, quote, a new perspective to improve performance of Disney's set of assets, especially at a time when the media industry has rapidly changed and Disney stock has struggled. 2022 was the worst year for the stock since 1974. So this is a crucial time for the company, and we've heard varying opinions on what should happen next, but certainly a lot needs to be addressed during this earnings call tomorrow. I don't think Iger will directly address the Peltz drama unless he specifically asked about it, but we do need to hear other things. Number one, what is Disney's streaming strategy, along with possible layoffs, restructuring efforts that Disney has been teasing for quite some time. But ultimately, no matter what is discussed on the call, Yahoo Finance will be breaking it all down with our After the Call special shortly following tomorrow's earnings. So be sure to tune into that. It's going to be a good one because there is certainly so much to discuss.
I love our after the calls. I mean, you really do get like the immediate breakdown of everything that went on. I mean, and there's a lot in the Disney pie. Beyond, I know we talk a lot about the streaming, but you also have the parks and how that's been trending versus, say, Universal Studios and everything else. What do you think are the real parts of the business that will really be in focus? And of course, with Bob Iger's return, maybe perhaps any sort of inkling as to where the company goes from here?
I mean, the tone that Bob Iger strikes on this call is going to be paramount for that stock reaction post-earnings. But you mentioned the parks, and we saw in the last quarter that the parks did lag when it comes to revenue. Now, Disney has said the holiday period was super strong, so I do expect those parks to rebound, but we'll have to see. It's usually a good indicator of the state of the consumer. But parks, streaming, strategy, Hulu, ESPN, this activist fight, I mean, there's a ton to get into.
It's a lot. Could be a special on Disney all on its own. A big thank you there to Ali Canal for getting us up to speed, and we look forward to that after the bell as well tomorrow. All right, well, let's do a final check of the markets before we go. We see it's turned into a mixed picture now. We see the S&P and the Nasdaq turn positive. The Dow still in negative territory there, down about 60 points on the day. The S&P there up about 0.1%. The tech-heavy Nasdaq there down just about 0.5%. And in terms of top trending tickers, keep an eye on Bed Bath & Beyond. That is our top trending ticker, looking at other meme stocks, GameStop as well. And of course, Baidu also trending as it launches its own version of ChatGPT. All right, we'll stay tuned later for a conversation with Microsoft's head of devices and search at 4:10 Eastern. You won't want to miss it. That's it for now. I'm Rochelle Akufo. I'll see you tomorrow.